Are we ready?
One moment.
Okay.
All right. We should be live now. Yes, go ahead.
Thank you, Don. Thank you, everyone. Good morning and welcome. It is 11:02 and we will start the Banking Committee public hearing. Before we go to comments by the chairs, I want to welcome everybody and just review some basic guidelines for these virtual CGA meetings. And these are not specific to the Banking Committee. These are general guidelines for all committee meetings and hearings that we have been told. Number one, meetings will be conducted at a slower pace to accommodate the quality of the live stream and preserve the integrity of the vote. We're not voting today. This is a public hearing, but we recognize that this is a new format. Number two, all participants will be muted until they are required to speak. So when you need to speak, please unmute yourself when you're called upon. Members of the committee, please raise your virtual hand when you want to ask a question or speak, and then Representative Doucette or I will recognize you and then go ahead and speak. We are not allowed to use emoticons or the chat. If you are a member of the public or a legislator and you're here to testify in support or in opposition to a bill, please say your name, the number of the bill, and whether you are in support or whether you oppose it, and then proceed to give your testimony. Everybody is given 3 minutes to speak. Dawn has a timer that will go off after 3 minutes, and at that point, if you could just please wrap up succinctly, you will be given the opportunity to speak if questions are asked to you by any of the committee members. Any foul language will mean that you'll be instantly muted, and we know everybody will behave themselves, so we're not concerned about this. But let's get started. So, Mike, would my co-chair, Representative Doucette, like to say anything?
Nothing in particular, Madam Chair. Just good to see everyone. Look forward to a productive hearing today, and let's get going. Thanks.
Senator Berthel or Representative Delnicki.
Good morning, Madam Chair. Thank you. Hello to everyone. I agree with the good representative. Let's get going.
Good morning to the chairs and the viewing public. This is always the fun part, hearing what the people have to say and having an opportunity for them to speak. And I look forward to today's public hearing. Thank you.
Wonderful. Thank you. Would vice chairs, anyone else like to make a comment? Vice chairs.
I look forward to today's discussion. I think it's very important that we do get public input, and I'm very proud to be part of that process. You know, I've always said for a long time that we cannot represent the people if we don't know what the people are saying and what they're believing. And I think this process is very important for us to make educated decisions as we go forward for the state of Connecticut. So thank you for that opportunity.
Thank you, Representative Gucker. And we are all in agreement. This is the critical part of our job of legislating, is listening to and learning from the public. So, and our colleagues, other elected officials and members of the administration. So we are going to start today with our first speaker, Matt Smith from the Connecticut Department of Banking. Matt, take it away.
Thank you, Senator Kasser. Good morning, everyone. It's really good to see everybody in this virtual setting. My name is Matt Smith. I am with the Department of Banking, and I'm here today in support for two bills, Senate Bill 848 and 849. These are agency proposals that you guys have actually probably seen several of them before in past sessions. And I'm here also to talk in opposition to proposed House Bill 6323, an act establishing a Connecticut state bank. So without further ado, thank you, co-chairs Kasser and Doucette. ranking members Berthel and Delnicki, and honorable members of the Banking Committee. The first bill, Senate Bill 848, an act implementing the Department of Banking's recommended changes to the banking statutes concerning financial institution, does several things. In Section 1, this is an attempt to reduce regulatory burden. The proposal would allow banks and their holding companies who are free of any regulatory restrictions to submit a consolidated audit report on an ongoing basis instead of submitting individual audit reports for each entity, and eliminating the need to get annual approval. Typically, if they wanted to do this, they would have to approach the commissioner each year. This would eliminate that, that requirement. The second section incorporates new federal banking regulatory capital standards called the Community Banking Leverage Ratio, CBLR, into the banking law of Connecticut. CBLR was designed to apply different standards to smaller banks, those with assets under 10 billion. This bill would allow community banks to continue to take public deposits and who choose to apply the CBLR. Right now, the law is silent because this is a new federal regulation, a new federal option that came out. We're just sort of updating our statutes to make sure that our community banks can take advantage of it when taking public deposits. Section 3 is another attempt to reduce regulatory burden, this time on our Connecticut credit unions. It eliminates an unnecessary step for the commissioner to endorse a certificate of incorporation. Basically, the credit union, when it incorporates, they already need the commissioner's approval. To endorse the certificate of incorporation seems to be a redundant step. So we're looking just to eliminate that step for our credit unions here in Connecticut. The second bill, 849, makes recommendations to our consumer credit licenses. It does several things. It clarifies that once a municipality sells a lien, including sewer and water liens, to a third party debt collector, and they no longer have an ownership stake in that debt, the company that buys the debt is subject to our consumer collection laws. Right now, there's a little bit of a loophole that we're looking to fix. I think there was when the law first came into effect, there was a bit of a drafting error that caused confusion around that. So that's one thing that bill does. It allows startup money transmitters. So this is another type of license with the department to submit to the department a conditional financial statement. Currently, it reads that we require audited financials, but for a startup company with less than a year in business wouldn't necessarily have those audited financial reports. So a statement of condition in lieu of after a year, they would follow the audited financial reports. There is a conforming change to federal law that gives mortgage loan originators temporary authority to operate here in Connecticut. Again, this is a conforming change. Mortgage loan originators can already do this in Connecticut. What we do is we're just catching up the state law to mirror the federal law. Creates less industry confusion, makes them know that, okay, yeah, Connecticut's on board, and they don't have to worry about, the feds say this, the state says this, what do we do? So it's really just intended to clarify that for industry. There is another proposal in here that you guys have seen before. It has to do with shared appreciation agreements. And this section of the bill would require entities and individuals that make, originate, or broker shared appreciation agreements to become licensed by the department and subject to our consumer protection laws. You can read a little bit more about that in the written testimony. I know I'm pressed for time, so in that interest, I'll leave that open for questions if anybody has any. And then there's some minor technical changes and a clarifying change on what a change of control is for different companies under our licensing authority. And happy to answer any questions on those two bills. Finally, there is a proposed House bill that would establish a state of Connecticut bank. This is an issue that has come up before the legislature several times. And I just wanted to weigh in a little bit on this. This concept has been thoroughly vetted over the last 10 years by not just Connecticut, but across the country. In the past 10 years, there have been approximately 10 studies, DC, Seattle, the University of Washington, the Washington State Treasurer's Office, California, New Jersey, the city of Santa Fe, Vermont, the state of Hawaii, the Commonwealth of Massachusetts, and the state of Maine have all done a study on whether a public bank would be a feasible idea. Each of these studies has concluded that it is not, generally not in the best interest of the state to create this type of entity. There is one public bank in all of the country, in all of the 50 states. That is the Bank of North Dakota. The Bank of North Dakota was created in 1919 to meet an actual market need. And what it did is, at the time, there was a monopoly on lending services. And what it did, it favored larger farmers. So in order to make capital available to the smaller farmers, the Bank of North Dakota was created. It was created in a very rural community at a time where there were very immature financial markets. That has typically been the model that people would cite when they look for a public bank. Well, a couple of things. The bank was started with $2 million in capital, which 100 years ago was a lot of money. A few years after it was initially started, they realized that that was insufficient capital for the bank in order to operate safely and soundly. And so what they did is they required all public deposits in North Dakota to be deposited into that bank. Within 3 weeks of that happening, 18 banks failed across the state. I would cite for you one, the banking department in 2012 did do a study on this, which I could forward to the committee if they'd like, if they don't have it. Part of that study is we refer or lean on a study that was done in Massachusetts by the Boston Fed, which thoroughly looked at the Bank of North Dakota, what the part it plays in the economy of North Dakota. One, both by demographics and economies, Connecticut and North Dakota look very different. Connecticut and Massachusetts look very similar. You know, North Dakota has a population of under 750,000 people, largely rural, and a much bigger agricultural economy. Connecticut, very different. What the Bank of North Dakota does is it provides some services that are already met here in the state. So we have quasi-public agencies like CHAFA, like CHESLA. We have CDFIs like HEDCO and the Community Development Fund down in Meriden that all sort of do the functions that the Bank of North Dakota provides for the state. The Bank of North Dakota also acts as a lending partner with its community banks. Well, that was started since then in the maturation of financial markets. What we have now are what we call bankers' banks. And when a community bank wants to, say, do a loan, and it may not have the actual resources to do that, it would partner with a bankers' bank that operates here in Connecticut, and it would be able to do that loan. So I could go on, and I know that we are pressed for time, so I don't want to take up too much of your time. But I think that the department feels that the services and the whole that the Bank of North Dakota provided for the state is already being filled here in Connecticut by some really great institutions like CHAFA and CHESLA, et cetera. So with that, I will be quiet, and I welcome any questions that the committee has.
Thank you, Matt. Thanks for your testimony. I do not see any raised hands. Do any members have questions for Mr. Smith? Representative Delnicki.
Thank you, Madam Chair. And Matt, thank you for coming before us today and providing us with some testimony. I just want to probe the consumer collection rules and the third parties that buy the delinquent taxes from towns and cities, whether it
Yes.
be sewer or whether it be property tax. Have there been instances of some of these folks being less than amenable when they deal with the folks that they buy the tax liens from? In other words, if Tom Delnicky had a tax lien with the town
Yes,
of South
so,
Windsor, South Windsor sold it.
So what happens is I'm sorry, I'm having a little computer problem here. What happens is when the third party buys the debt, it doesn't necessarily comply with all of the consumer protection laws that a regular consumer collection agency would have to abide by, partly because when the statute was drafted, in the definition of consumer debtor, it referenced personal property taxes. And as you know, towns tax real property and personal property differently. And so these third-party debt buyers from these municipal liens have argued that because the statute says personal property, that the real estate property that they're collecting on is exempt from our laws. That was never the intent of the law. And when it was passed. And so this really seeks to rectify that. And so I guess more closely answering your question is that yes, consumers are potentially and have been subject to aggressive collection tactics that may fall outside of our consumer collection statutes that ensure protections for consumers. Does that answer your question?
Yeah, that does, because I wondered what the nuance was there. And I was always under the assumption, and wrongfully here, that regardless of whether it was personal or whether it was real, you had those standards applied, but you apparently we don't. And that will actually bring them into compliance.
Yes, I think that it was likely, I don't know this for sure. I know the intent was to always capture both, but I think it could have been just a drafting error when that just went uncaught. But it was always the intent to include both real and personal property, and that those debt buyers are subject to Department Consumer Collection Agency laws and licenses.
And sewer liens are also covered in that?
Yep, sewer and water.
And water. Shared appreciation agreements, I've got a real problem with that instrument. So by being able to regulate them, we'll be able to stop some of the practices that have been very troubling in that
Yes.
in that group.
Right. And again, with that, the biggest problem that the department is that it's a loan, and you can call it whatever you want. You can assign fees rather than interest rates. We saw this a lot with the payday lenders here. There's, we're just charging big fees. It's not exceeding the usury standard, right? Similarly, shared appreciation agreements, they don't call it origination fee. They call it, I forget what now, but they just add a different name. We're like, no, though that's part of the interest, that's part of them, just like a mortgage. And we view this in very much the same way that this is like a home equity line of credit or a second mortgage that somebody might take out. The instrument acts a little differently in that it's an equity stake in the property, and it's something you don't have to pay back for 10 years. But what it does count on that the property will appreciate in value, and will take some sort of percentage of that appreciation in value, which really amounts to an interest rate. And that's why we think that it falls under our mortgage licensing scheme, and it should. Is this a product that's going to be suited for everybody? No. We don't think so. We think that, but we do think that people should have options. And as long as it's regulated and subject to our examination and consumer protection laws, we can go in, we can go and demand any records from the company. We can force them and sanction them if they break the law. Currently, those standards don't exist. And this also carries with it, again, another area of great concern. My dog is barking, by the way, if you hear that in the background. Now I lost my train of thought. It has with it the ability to foreclose on the property. And that is of great concern. Because it has a lien that can foreclose on a property, we think it's even more important that we be able to regulate them so that consumers, are given the proper disclosures and that they are thoroughly protected.
Yeah, I was gonna follow up on the disclosure portion because it seemed to me that was very lacking.
Yes.
There were no real regulations there. Lastly, you spoke about proposed House Bill 6323. And just to be clear, can you just address the Bankers Bank in a little more detail? I had not heard that before.
So I'll do as best I can, and we'll see if it satisfies your question. So sometimes a bank with a smaller asset size may have the opportunity to lend to, but it's a particularly large loan. Again, when we go in and examine them, we look at how risky the loan is and whether or not the lending practices are done in what we call safety and soundness, right? And a bank will be like, maybe they don't have the sufficient capital to, cover the loan or whatever. They can go to a banker's bank, and the banker's bank would either participate in the loan so that they would share the risk with the financial institution, or they could lend the money to the community bank in a different way. It's almost like a wholesale market for, I don't know if that's going to be accurate, but it's a bank that only bankers have access to. Okay. Generally, it's not a retail deposit taking sort of institution.
Okay.
And that's and that's really their function, is that they help banks make loans that may be outside of their bailiwick or whatever.
So just to be clear on this, there's no issue pertaining to banks not being able to have the capital to make loans because they have an ability to go to the banker's bank and get that capital. And do you see any reasoning for having a state bank?
I don't. And I think that, the department is clear that, and particularly with Bankers Bank, there are, more than 26 states have what's called a Bankers Bank. And we think that I didn't even address the capital requirements that would be required to create an institution of the size that typically these would do. I mean, when you look at, in order to have a good sort of leverage ratio, if you have I'll just pick like $1 billion institution in assets, right? You would need over $120 million to start that bank. So it would require a significant upfront capital requirement in order to start. You guys are the appropriating authority. I would say that I don't know if the state has those kinds of funds, but there is a significant capital requirement that should be considered when and if you guys, the legislator chooses to bring this up.
Well, thank you. Thank you, Matt. Thank you for coming today and providing testimony. And thank you, Madam Chair.
Thank you, Representative Delnicky.
Thank you, Representative.
My co-chair, Representative Doucette, has questions for you, Matt.
Thank you, Madam Chair. Hi, Matt.
Hi,
so picking up where we just left off real quick on the Bankers Bank, I see, I don't know if you submitted separate testimony on
I think it was
the,
on its way. It was separate. If you haven't gotten it, if they haven't gotten it yet, you should be getting it
okay,
soon.
I haven't seen it yet, so I'll look for that. I was just going to ask you for some more detail on that, on the Bankers Bank piece of it. And the report that you referenced, did that also touch on that specific
Yes.
element, the
it
Bankers
does.
Bank?
It
Okay.
does. Yes,
If you could,
and I'm
if you
happy
could
to
forward that
all
to
of that.
me, yeah, forward that to me again. I'm sure I have that somewhere from perhaps from a couple of years ago.
Sure, sure. I'll
Okay, and then
I'll
going
forward
backwards.
I can forward the banking department. Oh, sorry.
Yes, right.
Sorry.
Yeah, just forward. Yeah, please forward that again. So I
I'll
have
forward
it
our
back on.
study and the Massachusetts study, which is what we relied on.
Great. Okay,
Yes.
and then going backwards from where Representative Delnicki left off, shared appreciation. We've had this conversation a few times over the last few years, and my question, is there any activity in this market right now that we've observed in the state of Connecticut, shared appreciation products?
So there was activity, when we originally proposed the bill back in 2019, I think was when we originally proposed, or maybe it was 2018. We have seen it drop off, but we've seen it drop off. Right now, we're not seeing a lot of solicitations, but there was a great deal of activity about 2 years ago where I personally got a couple of solicitations in the mail for it. So
okay, but nothing formally that's risen to the banking department's level in terms of any complaints or open matters or anything concerning.
No complaints. Okay. No complaints, but given the structure of how these deals generally do go, we're likely not going to see any complaints for several years, because typically the term is 10 years. So, when a balloon payment comes up and they need to pay everything, and, they realize that they didn't get any disclosures or they didn't understand the financial product, that's when we would actually see the consumer harm. So we may be a few years away from seeing any types of complaints around this.
Okay. And, we've had this discussion as well over the years. If we wanted to just ban this activity, would that be something that the department would be supportive of? How would we do that? And are there other states that you're aware of that have actually gone as far as to ban these products?
There are states that are looking at it. I think Connecticut, we're a little bit ahead of those other states in actually proposing legislation around it. So I do know that. I can't remember what states are actually looking at it, but I can find that out for you as well. So I think in terms of banning the product, I think that there was some similar hesitation when home equity lines first appeared on the market. The department believes that consumers should have choice, and certainly what works for one consumer may not work for another. But that's why we think it's important that we have access to those records and that they follow the regulations of the department.
Yeah, no, I think that makes sense, and it's certainly a step forward, because there isn't a tremendous amount of activity in this market right now, but this would be a good step forward towards regulating it. Shifting a little bit to lead generators and the temporary authority provisions. Can you walk us through some of the changes? I believe it referenced in 2017, there were some changes to the lead generator statutes, how those came about. And then my other question is, are those provisions consistent, or would they be consistent after this change with what the federal regulators do on the same on the same front, on the same issue? On
the temporary authority?
Of lead generators first, specifically, the definition of lead generators.
To answer that, I'm not sure if there's really sort of any federal law that we follow on the lead generation portion. So that was, again, I think Connecticut was out front back in 2017 what we actually did was starting to require them to be licensed. They weren't licensed beforehand. And in 2017, our lead generation statute, we were one of the first states, I think, that actually started licensing this activity. As you know, I think I'm pretty sure you're aware, basically, these are companies that, like when you're, we'll say, on a website and they're like, oh, we can, you can refinance your mortgage. And, you go in and you fill out all of this stuff. And to be honest with you, I actually did this once, and literally within a minute of sending that, I got a call from Rocket Mortgage about, wanting to refinance my mortgage. So we saw that this was a robust activity that, should fall within our statutes. Basically, we created it now that, and I just remembered this. Prior to actually carving out a lead generation license, they were licensed under mortgage brokers. But because of the nature of the activity, they couldn't comply with our record retention, some of our record retention requirements under the broker license. So this was carved out in a way to encourage the activity, because they were doing lead generation activity, but were risking being subject to department exams and scrutiny because they were under our mortgage broker license. So this carved them out and put them squarely as a separate license that didn't have some of the burdens that a mortgage broker would have, because they're not engaged in that type of activity. And so what this change does is, for instance, if an investment advisor is talking to a client sitting in something like a JP Morgan Chase, we'll say, or whatever, and they're like, oh, we're, they're having a conversation and they're thinking about, refinancing their mortgage. The investment advisor might say, oh, why don't you go over here, next door and talk to one of our mortgage loan officers or whatever. There is the risk that that type of incidental activity could fall under the lead generation statute and require them to be licensed. What this does is it clarifies that that's not who we're trying to capture in this statute. And this was originally proposed the year after we created the lead generation license. And, and again, we're always engaged in conversations with industry. And it was at their request that, we worked out some language that everybody was comfortable with to make sure that, there wasn't rampant activity, but just the incidental sort of like what I just described, those kinds of conversations wouldn't fall under the lead generation statute.
Okay. And is this change consistent with other states' treatment of this relationship? I'm not sure. I know there aren't a whole lot of states that have this carve out of lead generation, and I can certainly look into, but I don't know off the top of my head if they have this type of provision. Okay. And then just one last one about the temporary authority provision. Can you explain how this makes us more consistent with the federal law?
Right. So the federal law basically allows, if you're licensed in, we'll say, Massachusetts, and you come to Connecticut, prior to the feds passing the law, that mortgage loan originator would have to wait until their application was processed by the Connecticut Department of Banking before they can engage in any mortgage loan origination activity here. What the feds did was say, okay, well, if you're licensed here, you can temporarily continue to work while your application is being processed by whatever other state regulator you're going to. And what we're doing is just mirroring that language, putting it in our statutes, so that if somebody does want to move to Connecticut and they want to engage in mortgage loan origination activity, it will be clear by reading just our statutes that they can do that if they're licensed in another state, that they can do that while their application is pending before the department. And it's really just to make it a little easier for them, so that there's no confusion that says, oh, well, I thought the feds passed something, but I don't see it in Connecticut. It just sort of makes it consistent all in one place.
Okay.
Probably the best way to say that.
All right. Well, thank you. Thank you for your testimony this morning. There's certainly a lot here. Thank you for your good work over a number of years to help put these together. And yeah, look forward to seeing some of these. There's some important pieces in here. Thank you.
Thank you. And thank you again to the committee. The department always appreciates all of the support you've given us over the years.
Thank you, Matt. And I appreciate what you're trying to do, reducing regulatory burden, making the processes more efficient and streamlined, and helping community banks access better policies put out by the new federal government. So thank you so much for that. Oh, I do see more questions. Sorry, you're not off the hook yet.
Nope.
Representative Lanoue has questions for you.
Good morning. Thank you, Madam Chair. Good morning, Mr. Smith. How are you?
I'm well, thank you. How are you, Representative?
Very well. Nice to see you this morning. I just had a few questions about the proposed state bank in HB 6323.
Yes.
If you're able to answer some of them. If not, that's okay. I'm just trying to get an understanding and get a foundation of this.
Sure.
I'm just trying to understand now, what would the structure look like, as far as what would the structure of a bank be? Who would determine essentially who would get the loans? Is there a board of directors? Is there a vice president of the bank of lending?
So I'm not really sure. There's not a lot of precedent. If memory serves me, I will refer to the Bank of North Dakota. And again, this presents sort of another fear or another risk to creating this type of institution. Those are appointed by their political appointments to a board. So the governor or something would appoint this board, possibly looking for, approval from the General Assembly or whatever. So what happens is, in that kind of environment, you do run the risk of having it politicized, which would increase, the risk to the bank. I will say that the Bank of North Dakota does enjoy a really good reputation as staying out of the political realm.
Now, so for example, if I wanted to get again, let's see if I understand this correctly. If I want to get a home mortgage or a car loan, or I have options of local community banks, maybe a larger scale bank, or the Bank of Connecticut, and I can that would now be in the fray. Am I understanding that correctly?
I'm sorry, again?
Yeah, I chopped that up. I apologize. So if I wanted to save a car loan, a home loan, if I wanted to apply for that, would it be if I want to go to different community banks, different lending institutions, credit unions, I would have all those options, and I would also now have the Connecticut State Bank as an option?
That would be my understanding, yes. So it would be a competitor in the marketplace.
Okay, so we'd have a state-run bank competing with different lending institutions within the state of Connecticut.
Is my understanding, yes.
Okay, all right. Will there be like a criteria as far as who's eligible for a loan and who's not, or would it be at the beholding?
That would be, after. So right now, the only thing we have is a proposed bill. So, we sort of need to see actual drafted language in order to make a substantive comment on that. But from the department's point of view, there would have to be some sort of lending standards that would be consistent with what we call safety and soundness of the institution, to make sure that the underwriting is consistent with their capital and their risk portfolio, their risk profile.
Mr. Smith, thank you very much for your answers. I appreciate it. And again, thank you for appearing today. Thank you, Madam.
Okay. Seeing no other hands for questions, I think, Mr. Smith, you're out of the hot seat. Thanks so much.
Thank you, Senator. Have a great day, everyone.
Thank you. You too.
Thank you.
Okay, now we are moving to our second speaker, Representative Susan Johnson, who here she is. She is with us.
Yeah, great. Thank you so much, Senator Kasser and Representative Doucette, and distinguished members of the Banking Committee. I am so pleased to have you raise House Bill number 5610, an act requiring and expanding access to certain loans issued by higher education through the Supplemental Loan Authority, and also House Bill 6323, an act establishing a state bank of Connecticut. And I'm Susan Johnson, and I represent the 49th House District, which is pretty much the whole town of Windham. So I just can't tell you how appreciative I am of your work and raising this bill. And it has been brought before this committee before. And let me just first say that I think that this is very important. House Bill 5610, an act requiring and expanding access to certain loans by the Higher Education Supplemental Authority, because as you all know, and we're all very aware, students are paying higher tuitions, and they're also paying a higher interest rate most of the time for their student loans. And this would help out with student loans. We need to have our students graduate and be part of our Connecticut economy instead of working to pay back a huge amount of student debt. So whatever we can do to mitigate those issues, I think is something that we need to really work hard on. And I'm so pleased to see this here as a proposal. Also, as you know, the House Bill 6323 is an act establishing a Connecticut bank, which would not be a competitive bank. It would act much like a banker's bank, just like the State Bank of North Dakota. So they would not be taking loans, issuing loans to private citizens. They would really act as a private, a banker's bank to work with all of the small banks, primarily in the state of Connecticut. As you all know, and I won't read my testimony, I'll just tell you from what I think about how this should work. And I really believe that this would just be something that would help our small banks that are really focused on our Main Street. They are really focused on Main Street and trying to take care of our local communities. By having more and more small banks swallowed up by the larger banks, they have less of an interest in our local communities. And as a state that's divided into 169 towns, it's important to have that local financial institutional support, and getting that support from the state of Connecticut, working together with all the different things that were just described by our banking commission. They really would benefit from being in one centralized area, so that we could take a look at all the different authorities that we have. One of the things that happened back when Commissioner Pitkin went to try and establish a public bank in Connecticut was we ended up creating the Green Bank, which has been very, very successful. And it has been really very successful in leveraging funds throughout the state and expanding access to all types of things that will help us with our future economy and our problem with global warming and global changes. So this is something that would be something that we would be able to see a real positive change in. And also, it would also help us with the maybe we could use it to focus on municipal needs and also for nonprofit needs. And we could start out using it very similarly to the Green Bank and using it as a banking authority, or with the way I proposed this legislation would be more broadly addressed by being able to also use it as a depository bank, so we could borrow straight from the Fed at a 0.25% interest rate. And it would limit the amount of tax dollars that our taxpayers in Connecticut would pay in this situation for interest for our loans. So those are some of the reasons that it would be very good for us to have a Connecticut bank and establish it as a banker's bank, working with the existing banking groups that we have now, but putting it under one roof so that we will have a better handle on all these different things that we're doing and maybe be able to leverage more resources. So that is the idea behind the State of Connecticut Bank. And I wanted to just say one more thing about this, and that is the CARES Act that we had this last, because of the pandemic this last year. We noticed the State Bank of North Dakota was very, very efficient in making sure that the small banks were able to leverage that money because they developed expertise in the area so that they could get that information right out to the small banks and to the businesses. This did not happen in Connecticut, at least not in my part of Connecticut. I have a lot of businesses that were not able to avail themselves of the CARES Act money because the banks didn't have the technical capacity to be able to make those loans to these small businesses and banks. So I don't want to go over my 3-minute limit, but I do appreciate all of the work that you're doing and working with you to make sure that we try and do something like the state of California just did. That's what this proposal is very similar to. State of California just passed a general public banking bill for California. And then we could make sure that we make it into the banker's bank, make sure that we don't have the politics like people were speculating on, and proceed like the State Bank of North Dakota has, and making sure that we expand our Connecticut economy here. So thank you so much for all you do. I appreciate it.
Thank you so much, Representative Johnson. Senator McCrory has a question for you.
Thank you, Madam Chairwoman. Representative Johnson, I'm kind of intrigued about this concept of a state bank. I don't know if I want to call it that, but I'm really intrigued because of the fact that we have so many communities where banking is not available. Banking doesn't exist. There's a lack of access to capital. And the idea behind having a quote unquote state bank or something that magnitude intrigues me because there are so many communities that don't have access to capital, and our traditional banking partners are not willing to go there and provide access to capital. So I want to explore this concept a little further with you because it sounds like something that we need to implement in the state of Connecticut. So I'll reach out to you, and I just want to explore that.
I could answer just a quick, and we can go into this in more detail, but the Connecticut Conference of Municipalities is one way that we could leverage funds and create a banker's bank for municipalities and nonprofits. This would help our low-income communities. We would of course go by banking standards, but we would be able to combine this, work with CCM to make sure that our communities that are not getting the access to banking anymore have the access through the state. And by combining all the resources of the state, all these separated authorities and so on and so forth into one umbrella bank, and then work it that way. So nonprofit organizations and municipalities could work together. Municipalities, as you know, issue bonds. So this is one way that we could address the problems with our distressed municipalities, our serving towns, as I like to call them, and make sure that we expand our economy all throughout the state, because the more we help one town, the more we help the surrounding towns. And that's the way it would work, because the circular flow of money is what we need to do, and we need to expand that here, not contract it. So we've lost some banks, some smaller banks, and this is one way to have those small banks that we have left get that kind of support that they need. So thanks for the question.
Thank you. Thank you.
Representative Doucette.
Thank you, Madam Chair, and good to see you, Representative Johnson. Thank you so much for coming today and for your advocacy for this issue over many years. I do think it's an intriguing issue, and I thank you for keeping it on our agenda. I do need to dust off the report that was done by the Department of Banking and sort of revisit that. And I know that it was done in 2012, so it very well may be stale and need to be looked at again. But a couple of questions about that. I guess one is, have you reviewed that recently? Are there any missing pieces of information or updates that would be necessary to that report? And two, the conversation, I don't know if you heard earlier, that we had about the concept of the Bankers Bank. In that report, because I was just opened it up and reading sort of the summary conclusions, it mentioned that Connecticut already is a member of, at that time it was called the Bankers Bank Northeast, but I believe it's called the Atlantic Community Bank currently. Are you aware of that? Is Connecticut able to utilize that Bankers Bank, and what would be the benefit of having our own as opposed to being a member of that community bank or larger Bankers Bank?
Well, generally, I can only speak to what I've learned through this process and through the Public Banking Institute, and also through the newly established group that we have in Connecticut for public banking. And that is, this would be a Connecticut bank would have more transparency. It would be focused on the resources here in the state of Connecticut, making sure the small banks here in the state get that support that they need. And again, it could provide the technological and the legal support for smaller banks, so that we wouldn't miss out on funds that, like we missed out on this last time through the CARES Act. And that was demonstrated by the fact that the State Bank of North Dakota was able to quickly provide those resources to the small banks and then to the business community. So it would be focused on our local issues. Connecticut Bank, that does not mean that we couldn't have public banking. I think we can have public banking in the Northeast section. But I'd like to see how it would work here in Connecticut first, and look at how we can organize and put together all the authorities that we have for lending and all the things that we do that are all separated out. It's kind of like Connecticut and the 169 towns that are all separated out, and they really aren't sure what the other ones are doing. Putting it under an umbrella, making it so that it's not competing, but supporting our local banks, keeping the money here in the state so that we could actually borrow at a lower rate from the Fed, would actually help us with our taxpayers and our debt. So those are the kinds of things that I'm thinking of when I think of a public bank. And I think that, of course, the board would be structured just like any bank, just like the State Bank of North Dakota does. And we're looking at this because I think we're so far removed from when we used to have public banking. And if you take a look at the proposal for an infrastructure bank, and the fact that there's going to be an infrastructure bank proposed again in Congress, this would help us link in with that more quickly, so we would be able to access the infrastructure money that could be coming to Connecticut more quickly. So there's another aspect of that, and I know there are other states that are doing resolutions to support the infrastructure bank coming to us on the federal level. So that's another way to look at it. So the pandemic has brought this to lights, and the fact that as our small banks merge with larger banks, they're not as focused on our local communities, and it would be more transparent for people in Connecticut to be able to know what's going on with banking and have a good handle on how to do that for the communities and for our municipalities and nonprofit organizations.
No, thank you. No, I think that's a good point, that the pandemic has brought this into light and framed this issue in perhaps a different way. And there are sort of more recent developments that merit us taking another look at this and perhaps refreshing, like I said, that report from 2012. So thank you again for continuing to bring this forward.
Thank you so much, Representative.
Thank you, Representative Johnson. I just wanted to clarify for my own purposes, because I went to the website, Connecticut Public Bank, and it did reference this as an infrastructure bank, and you've spoken about that and about the possibility of being a bank for municipalities. And I assume what you mean by that is infrastructure projects that municipalities might want to undertake could be financed somehow through this entity. Is that correct?
That's correct. Yes, the idea of an infrastructure bank for municipalities, so we can narrow the focus, so that, and we can gradually take a look at how we're doing banking all throughout Connecticut, and have it under that one umbrella, and really work together with our communities more closely. So yes, absolutely. I think the working with the Connecticut Conference of Municipalities on this issue, I think they would be very happy and very pleased to work with us on this. So and again, not a competitive bank, but supportive. And that's how we want to make sure people know that. And now with the Congress coming in with a whole infrastructure bank and the infrastructure needs of the state of Connecticut, as everybody's so aware of, this would really, really help us, I think, get a foothold in that as well. So having something general would be great. So thank you so much for the question, Senator, and thank you for your work on this.
Well, thank you, because as you know, I'm a huge proponent of having an infrastructure authority, an infrastructure financing authority / bank for the state. But the reason I'm asking this is I want to differentiate between what sounds to me like two different needs that you're speaking about. One is infrastructure projects that would be done by municipalities. The other is lack of access to affordable capital in underserved communities. So there's a racial equity issue that's being raised also. But that sounds to me like banking at the personal level, banking for entrepreneurs and people in underserved communities, individual banking, as very different from financing infrastructure projects that are building bridges and fixing highways that may be done at the municipal level. I just wanted to clarify that these are two very separate kinds of banking needs. Is that accurate?
Yes, the private banking needs is something that once we had a Connecticut bank, we could establish more support through our local small banks that provide that sort of help to our communities that have a need for funds. So we would have, as a Connecticut bank, that capacity to help those small banks in the communities that have problems with resources. That's different than working with all the municipalities, creating infrastructure projects in those municipalities through the Connecticut Conference of Municipalities as a group. So those are completely different. But if we gave the right support to the small banks, they could help the people on the ground in those communities. So it would be top down help. But because we don't give the support to the small banks, they're merging, and we're losing those small banks. And that's a concern of mine. And to lose the small banks in a state like Connecticut is really very scary, because they're the ones that are there helping our small communities and our bigger communities. And our communities in Connecticut are pretty small just to begin with, if you look at us compared to other states. So that is getting that help to those small banks that are left is, I think, a real way for us to help the people who need those loans that are not available right now.
Well, I think we're all in agreement that we want to help community banks, credit unions, the local organizations that really know their clients and know their communities and want to invest in them. Matt Smith from the Commissioner's Office did reference new federal standards that would benefit community banks and smaller banks in particular, with a more beneficial terms for leverage ratios. So it sounds to me like this is already in the works from the federal government down. I think maybe this merits further discussion with the department to see, where we can really hone in on the actual needs of the community banks to make sure that they have the resources and the backing they need to really be a consistent resource for communities and particularly underserved communities. So thank you so much.
Thank you so much. And that's really excellent point, and making that distinction is very, very important, I think, for our discussion. Thank you so much, Senator Castor. Really appreciate it.
Thank you, Representative Johnson. Okay, we are going to, seeing no other questions for you, I'm going to move on to your colleague, Representative Ann Hughes.
Thank you, Madam Chair. Thank you, chairs and ranking members of this banking committee, allowing me to come before you to testify and enthusiastic support for HB 5610, an act expanding access to certain loans issued by CHESLA, Connecticut banks, Connecticut credit unions, and also in support of HB 6323, establishing a state bank of Connecticut. You know, this pandemic has really exacerbated structural inequities. Again, you've talked about it all morning, with access to capital, to loans, to basically higher education in the first place. There's a lot of our professional community that didn't have access to the kinds of lower CHESLA loan rates because of their debt to income ratio. And now during this COVID relief, we have had some student loan temporary relief, but it extended only till September 30th, 2020. We've had some halts on collection companies, easing collections through September 30th, 2020. A lot of our young professionals, or even older professionals, have massive student loan debt. We're talking about working law professionals, UConn Med graduates, $200,000 to $250,000 loan payments. Now, a lot of those folks, a lot of my constituents are paying over $50,000 per year in interest alone. And because they didn't qualify for CHESLA, because of their debt to income ratio, they're paying upwards of 7 3/4, 8% interest rates on their loans. And that is nearly $4,000 of interest per borrower. That's going to Chattanooga or Pennsylvania lenders. They're not coming back into Connecticut. How can we capture that at a lower interest rate, which we're offering? CHESLA offers 4 to 5% interest rate, and seamlessly reinvest that back into Connecticut. Because right now, not only would it be a savings for all these, professionals, some of them are working, some of them are in between work because of the pandemic, some are getting back to work. All of that savings would be not only reinvested back into Connecticut. We're talking about, rent and car payments and, goods and services, but instead of going to these other lenders, it would be coming through CHESLA. And the same thing, it's an equity issue for folks that really have been denied traditional, lower borrowing rates and so forth for higher education, because they didn't have access to the capital or family support in, in sending themselves to graduate school, quite frankly, like I did. So I don't have that kind of, graduate debt and can work, in a more sustainable fashion. But so I would like to open up access and eligibility, and this would also mean that our general obligation bonds would probably increase under this proposal. But again, all of that would be reinvested back in Connecticut. And that's what we really want to do to get us out of this economic recession, is to really have these economic drivers into going back into Connecticut, Connecticut workforce, Connecticut goods and services, and Connecticut interest. That's really it.
Thank you, Representative Hughes, so much. Let me see. Representative Doucette has questions.
Yes, thank you. Thank you, Representative. Good to see you.
Yes.
And thanks for bringing this forward. You raised an interesting point. I'm not too familiar with this market. So you raise an interesting point about other lenders having perhaps looser underwriting standards than Chesla.
Right.
And I'd be interested to hear more about that, and it may require some more research or to communicate with Chesla or to have our nonpartisan research office do some digging on that. But what is your experience, or what are you hearing about, you know, what other lenders offer in terms of their underwriting standards? And you said you do actually know people who have had to go elsewhere for student loan refinances.
Yeah, most of them are these big, you know, these big national lenders, and again, they're in other states, housed in other states. So we get none of that money. Connecticut gets none of that money. It's just going straight out of people's, you know, very limited income into these, you know, and again, they're upwards of 8% or interest rates on these, and they can afford to because they're the big for-profit lending institutions for this kind of, you know, for this kind of market. And it deliberately, you know, it deliberately captures, you know, student loan borrowers that I don't think can ever earn enough to pay off the principal of that, you know. So we're condemning people to a debt cycle that we could be investing back into Connecticut and investing. You know, our Chesla is essentially a revolving loan fund. You know, it's essentially reinvesting in the new workforce and the new borrowers. And why wouldn't we want to expand eligibility, especially under this, you know, really catastrophic economic recession, you know, caused by COVID pandemic, and the moratoriums and the relief efforts aren't enough, and it's not recapturing that lower interest rate back into Connecticut. Like, let's help our workforce get back on their feet and be reinvesting that into our revolving loan fund and get more, you know, more of our graduates back to work.
No, it's absolutely a good point. And you're right. The more borrowers that we can get, the more business that we can generate through Chesla is good for the whole state. But yeah, no, I'd be really interested to know what the market looks like, where sort of the cutoffs are in terms of whether it's credit score or debt to income.
Yes, it's credit score and debt to income, even though, and actually, I believe some Chesla folks are going to testify today. I hope so, because I did talk to them and they're very interested. Yes, right. So
right.
they can,
and that was going to be my other point or question, is that we certainly have to have a dialogue with those folks. And Jeanette Weldon submitted testimony. I'm not sure if she will be with us today, but would want to have an ongoing dialogue with them. There are a lot of moving parts from what I know about the Chesla program, like the other loan programs administered by our quasi-publics. There are a lot of moving parts in terms of the way the bonds are issued, the bond ratings. The Treasurer's office needs to sort of weigh in. And so when we look at that, if what we're talking about is changing the underwriting standards, you know, how far can we go before it affects the bond rating, which really could potentially affect the whole program. So then another question would be, and I don't know if you know anything about other state quasi loan agencies or authorities, whether or not they have played with their underwriting standards or different underwriting standards to meet this issue.
I think, I don't know about other states, but when I talked to Chesla folks, they did say if they, you know, again, under this economic, you know, recovery sort of transition, as we try to do that, if we expand the eligibility and we don't use the same old strict, you know, debt to income ratio or credit rate. Because again, when people are unemployed or laid off, they're living on their credit cards, and then that just boots them right out of that eligibility bucket, basically. And then the cycle just, it compounds, basically compounded interest, right? But if we loosen some of those eligibility criteria, especially during this economic recovery phase, let's say, maybe we do it for 2 years or something, they would want to expand the general bond underwriting from maybe 7 million to, I don't know, 9 million or something, depending on how many, new borrowers they could capture under that. But that seems like a win-win for us to reinvest in Connecticut's workforce and Connecticut's revolving loan. And, again, I think the treasurer is very much on board with this, because it wouldn't really, I think it would increase our bond rating, especially if people don't default. And like I say, all these young professionals that I talk to, they want to stay working in Connecticut. They want Connecticut to get the benefit. They're still going to pay their interest rate. They want it to, if it's lower and they get to pay it into Connecticut, they are not wanting it all to default. They don't want to have even the loan forgiven. They want to pay it into Connecticut.
Mm-hmm. No, it's a good point. And you touched on this, I think, but one of the ways that CHESLA tries to incentivize borrowers is through interest rate subsidies, which again would require us to invest more. So
That's right.
it's actually, would be an appropriation or additional bond funds to subsidize the interest rate to incentivize certain borrowers. There's a proposal, as I understand it, for revolving around the minority teacher recruitment program.
That's right.
That's
Exactly.
pending this year, which sounds like a great idea to me. So there's always
Exactly, and I'm wondering
it's,
if we can use relief funds for this, some federal relief funds, again, as part of the economic recovery package to reinvest in those subsidies for borrowers. Like, again, I look at it through an equity lens. These are people that are denied, what other people who had access, or families had access to capital, to lending, to equity, don't have. So there's, it's very expensive to be poor, as you well know, or for your family to be poor, or to not have, assets, and to go to school and go to higher education, very, very expensive. How can we level that playing field for those folks?
No, it's an important discussion, and thank you for bringing this forward. Thank you for a lot to consider here.
Yeah, I believe that we have some better, more specifics signed up, or at least submitted for testimony, and I would love to send along the OLR reports, again, about the limited relief that we offered during COVID, and really looking towards a recovery-based relief in this mechanism.
Yes. Okay. Yeah, please do. Okay. Thank you. I think my co-chair may be taking a quick break, so
Thanks. So we're moving on to Gail Dennehy of CT Realtors. I'm going to be watching. I'm just also watching something else for a moment.
Okay. Thank you, Representative Hughes. So Ms. Dennehy, Gail Dennehy is here, I believe, correct?
Yes, let me get myself off mute. Good
Okay,
afternoon.
there you are. Welcome.
Thank you very much, Madam Chair, Banking Committee. My name is Gail Dennehy. I am from the Connecticut Realtors. I am their state legislative chair and a member of the executive committee. The Connecticut Realtors, or we call ourselves CTR, submits testimony in support of HB 5027, an act requiring the banking commissioner to establish a first-time homebuyer savings account program and establishing a tax deduction for contributions to first-time homebuyer savings accounts. CTR represents almost 18,000 members involved in all aspects of the real estate in Connecticut. The Connecticut Realtors work with thousands of buyers and sellers, landlords and tenants annually. The cost to purchase a home in Connecticut are significant. This proposal would assist in encouraging both contributions and savings for first-time home purchase. As of February of 2020, 13 states that have enacted variations of a first-time homebuyer savings account legislation is in place. The proposal would allow individuals to make a tax-deductible contribution to an account to be used by a designated person for expenses relating to the purchase of a home. A first-time homebuyer is defined as an individual who did not own or purchase, either individually or jointly with another person, a single-family residence previously in Connecticut. A qualified individual may open an account with a financial institution and designate the account in its entirety as a first-time homebuyer savings account. These funds could be used to pay or reimburse a qualified beneficiary's eligible costs for the purchase of a single-family residence here in Connecticut. Each account holder can contribute an unlimited amount of money. However, taxpayers may only deduct up to $5,000 a year from their gross income made into this program, or $10,000 if the account is opened jointly. The tax credit would be only equal to the amount deposited. For example, if an individual only contributed $1,234, he or she would receive a deduction for that $1,234 for that year from their Connecticut taxes. If an individual contributed $6,000, he or she would only receive that deduction of $5,000 maximum for that year on their Connecticut taxes. If the money to the account is withdrawn for a non-qualified reason, or if the money was not used to purchase a home within 10 years of the time the account was first opened, any money that was previously deducted but was not used for a qualifying purchase would have a 10% added to the account holder's taxable income for income tax purposes. This penalty does not apply if the withdrawal is due to death of the account holder, a garnishment, a levy, or a court order. These accounts would help individuals and families begin to create generational wealth in Connecticut by moving them closer to the dream of home ownership. The housing industry is closely tied to the economy. Buyers, purchasing will now be able to purchase retail items and hire contracts perhaps to improve their new home. CTR recognizes past concerns of the potential fiscal note on this program and attached statistical data from actual experiences in Iowa and Montana. Additionally, CTR welcomes the opportunity to work with members of this committee and the administration to incorporate options to make this proposal a reality. CTR urges your support of HB 5027 and hope you will enact the program to the benefit of those who want to call Connecticut home for their first home purchase. Thank you for your attention to this important matter.
Thanks so much, Gail. Thanks for your testimony, and thanks for providing that other information about the Iowa and Montana programs. That's always very valuable information in looking at programs like this. And I think, as you suggested, the fiscal impact is always a consideration, but it's good to see the experience from other states, and that would be a part of the conversation in trying to really get a realistic perspective on what the fiscal impact would be. So thank you for that. Questions for Gail? I see Senator Berthel.
Thank you, Mr. Chairman. Good morning, good afternoon, Gail. Good to see you. Thank you for coming before the committee today to provide your spoken testimony as well as the written documentation you provided. I have one question that just popped into my head while I was listening to you speak, and I know you provided statistics about what has happened in other states, but I'm just curious, and if you can't speak to this, maybe you can get back to me or get back to the committee, but what is the, on average, what is the amount that you see first-time home buyers coming to the table with today in terms of I would say cash, right? Because this would essentially be a cash part of a housing purchase, right? If you're buying your first house, you come in, you've got a mortgage, there's a certain amount that you're putting down, or maybe you're in one of the government sponsored loans and the amount is a lot smaller. But I guess my question has two prongs. I'd like to know if you could provide what that average dollar amount would be today. And then there's obviously an offset potentially in a positive way, that we may have some first-time buyers that can avoid things like PMI, private mortgage insurance, if they have enough cash that they're bringing to the table, right? Because we still have those thresholds for when the lending institutions require mortgage insurance. So I don't know if you can speak to either of those right now, but would love to follow up with you after at some point in the future if you cannot.
I don't have that information with me today for you, but we can certainly get that to you pretty quickly and be able to answer those questions that you've got. Great questions.
Great. Thank you. Thank you, Mr. Chairman.
Thank you, Senator. Representative Delnicki.
Thank you, Mr. Chair. And the good senator asked most of the questions I was going to ask. But as a follow-up, though, how important does the realtor community see this opportunity, this proposal, to actually helping folks get their first home and keeping folks in the state of Connecticut?
And that's exactly it. We think it's very, very important. We've seen many people leave Connecticut most recently, and we'd like to keep people in Connecticut and be able to purchase their first home here as opposed to going somewhere else. Connecticut has so much to offer, and I am a practicing realtor, and I'm in the field every single day with people, and I think that people have their families here and they want to stay here, and this can create another way of that happening. So thank you for your question.
And one more follow-up, and I loved your comment about helping create generational wealth. Are there situations with the folks currently that are first-time home buyers basically lacking that ability?
I didn't hear your question. Can you repeat?
All right. Your comment about generational wealth.
Yes.
And when you deal with a first-time home buyer, are you seeing a lot of impediments to them being able to come up with whatever funds they need to get a reasonable down payment there and to cover the closing costs?
Yes, definitely. It takes them quite a while sometimes to be able to save, and this would get them into the market more quickly and be able to get that first home purchase underway for themselves.
Well, again, thank you for coming forward. Thank you for testifying, and thank you for pointing out just how important the Connecticut realtors feel that this proposal is to the marketplace. Thank you. Thank you, Mr. Chair.
And thank you to everybody for listening to our testimony. Oh, is there another question?
I was just looking to see. I don't see any at this time.
Yeah.
So,
Ziogas?
Oh, yes, Representative Ziogas.
Yeah, I can't figure out how to do it the other way.
Okay, sorry, I didn't
Gail,
see you there.
Yes.
Yeah, hi. Gail,
Hi.
how do you explain the fact that the real estate market today is such a seller's market? There's multiple bids on properties, and doesn't seem to be there's a lack of buyers. So then that's what we're supporting, the new buying community. But we don't seem to be lacking that. How do you explain that?
I think last year when the pandemic hit, we didn't have a lot of inventory on the market at that point, and that created that buildup of people coming into the marketplace. But there's so many other buyers that just are on the sidelines. That this is such an opportunity for someone to be able to buy their first home and stay in Connecticut. That to me is very important. I've seen many families that were here and have left. And this particular program would give so many people the opportunity. And it's been so long since we've had a decent market in Connecticut. And we just want to continue to make that grow. So thank you for your question, though.
Thank you.
Thanks, Rep. Siogus. Anyone else? Anyone else? Okay, well, if not, Gail, thank you again. I appreciate your testimony, and it's a great point. It is a hot market right now, and this would be certainly a great way to help capitalize on that. So thank you again, and we will move on.
Thank you again.
Next on my list is Lisa Burns. Do we have Lisa with us?
Yes, I'm right here.
I believe we do. Hi, Lisa.
How are you? Good, thank you. This is my first time doing this, so I'm going to try to follow the instructions as best as I can.
Okay.
My name is Lisa Burns. I'm speaking on behalf of House Bill number HB 5090 regarding an act concerning mortgage forbearance and crumbling concrete foundations. As I said, this is my first time testifying before the legislation regarding crumbling foundations. My personal story starts in 2018 when my husband and I had suspicions about our foundation. We hired a structural engineer who confirmed that we had the pyrrhotite in our concrete. And so there's where our journey began from that point on. I can't tell you the endless nights that I've been lying awake trying to figure out how we're going to pay for all these expenses that go along with this project. Some are covered by the CFSIC grant, while others are left to the homeowner. And while I'm so very grateful for those victims and volunteers who worked hard to bring that grant to fruition, we still have a lot of unexpected costs associated with this effort. These costs include rebuilding, replacing, and repairing finished basements, landscaping, driveways, furnaces, and chimneys, along with other miscellaneous costs that are unforeseen and undetermined by the moving and shifting of the house and the land around it. So today I come to you and ask for your consideration and help to assist homeowners with moving and rental expenses. In many cases, homeowners must move out of their homes during these repairs, and these additional costs can hurt families and create a tremendous financial burden during these already stressful times. For my family, it would be an opportunity to focus the money towards the other unexpected costs. And it would be a huge relief to know that we don't need to worry about those expenses, which could add up to about $10,000 or more. In addition, I would encourage legislatures to work with the market mortgage holders and support mortgage forbearance for homeowners. On a personal note, I have had some very difficult financial decisions that have impacted my credit score due to this crumbling foundation issue. I've always been very responsible and had great credit. However, the future of borrowing money or background checks could stop my ability to get a new home in the future, a car, or a job. And now I find myself having to explain my circumstances to someone who doesn't understand the hardship. It's not my fault, and I find myself falling into another situation where I'm impacted by the concrete that I have no control over. So this will continue to follow me for many years to come. I hope my testimony will help bring attention to the larger challenges of this issue and policy change that is needed to support families dealing with crumbling foundations. We really need your support and understanding in this matter and with future bills. Thank you for your time and consideration.
Thank you, Lisa. Thank you for sharing your testimony with us today. What town do you live in?
I live in Tolland.
In Tolland. So you're right.
Right smack
you're right
in
in the heart. That's right. That's right. Any questions for Lisa today from any members of the committee? Anyone? Rep. Delnicki, your hand is up. Rep. Delnicki. But you are muted, Rep. Delnicki. So. Rep. Delnicki, there you go.
There we
Okay,
go.
good.
There we go. Thank you, Lisa, for coming forward and testifying. You may want to stick around. Jeff Gentis, I believe it is, from Connecticut Fair Housing Center, actually sent some information in pertaining to what New Jersey has done that conceivably we could add to the legislation, which would make it more encompassing. But again, I would assume that you've got an application in to CIFSIC for the repair of your foundation at this point.
Yes, but I do want to bring to your attention that it doesn't cover the full amount of
Right.
the concrete because my house is not the standard whatever house that was proposed. So there are some additional expenses. We have to come up with another $50,000 to fix our home.
Right. We also have a low interest loan program. I'm not sure if you're aware of that.
Yes, and we're trying to put all of these pieces together.
Great. Well, I'll tell you, it's been a real challenge trying to help people put their lives back together and their homes back together. But I can tell you that the good Chair Doucette and I are both focused like laser beams on this issue because we both have quite a few folks that are impacted by it and want to try to help everybody get their homes back in order and their lives back in order. Again, thank you for coming forward.
You're welcome. And if there's any questions, I'm happy to give you a little bit more of my personal experience. I think that some people's stories are not getting out there. Not everybody fits in a template. And, it's while the FSSIC is a super helpful, so grateful to have something like that. It doesn't take care of everything. And I've got a category 3. So it's an eminent thing that we need to do.
Yeah, you've got one of the worst with a category 3.
Yes.
Thank you.
Thank you.
Thank you, Rep. Delnicki. Anyone else with a question for Lisa? I do have one follow-up. I think it might be helpful for the committee, Lisa, to hear, have you approached your mortgage lender yet? And who is your mortgage lender? Because, I'll just tell you, one of the issues that we deal with in a lot of different contexts on the banking committee, but specifically with mortgages is our ability to regulate or to write legislation as it pertains to federally backed mortgages as opposed to state mortgages. And so, it might be helpful for the committee to hear if you've had any conversations with your lender yet and what those have been like.
Yeah, so it's been very frustrating, to be quite honest with you, and I'm happy to share more personal stories offline. I could really use your help. I have a Bank of America. And they have not been very helpful. All they've been able to offer us is a modification loan. And in between that time, we have accrued more interest on our loan. So while our home, and let me back up a little bit. Our home is, we don't have a lot of equity in the home. So now adding another bunch of interest on top of our loan really doesn't help us. It really kicks us more in the teeth. My husband and I have struggled to figure out whether we should just walk or continue this fight. I don't give up very easily, but it does get tiring when, it doesn't seem like the banks are really understanding what's happening here. And I understand there's contracts, but really this is not the fault of me or my husband. And it's something we certainly never expected or planned. I've obviously been impacted by COVID. I've been laid off. And, that doesn't help either. So how do we try to save money to get this house just fixed on just the foundation itself, and then have to do the repairs on top of that with the driveways? I mean, that's not a small amount of money. That's $10,000 there, if being generous. And then what happens if the chimney cracks during the lifting? That's a whole nother, $10,000 there. Landscaping, $10,000. Our unfinished basement, $50,000. So we bought our house unfinished or finished, I'm sorry, with a finished basement. And now what we're left with is a house that has an unfinished basement. That just doesn't seem fair to me.
Thank you. Thank you. All of that experience is helpful for us to hear as we consider this. Thank you. Okay. I don't see any other hands. So with that, I will thank you for appearing before us today.
Thank you so much for your time and your consideration. You'll see me again.
Okay. Okay. Madam Co-Chair, I'll pass the baton back to you for our next speaker on the list.
So our next speaker on the list appears not to be here. Chris Primavera. Okay, we will move on.
We may go back to that person.
Yeah, certainly. If they show up, we will come back. John McCabe. Okay, so let's move to Art Corey of the Connecticut Bankers Association.
Good afternoon, co-chairs Castor and Doucette, ranking members Berthel and Delnicki, and honorable members of the Banking Committee. I'm Art Corey, General Counsel with the Connecticut Bankers Association. Appreciate the opportunity to be before you today to testify on a few of these bills. First, the CBA supports the proposals in Senate Bills 848. Oh, 848. Can you hear me? Okay. Okay, I apologize.
Yes.
Senate Bills 848 and 849 from the Department of Banking. There are several provisions, as Mr. Smith from the department testified to, regarding banks that we are in support of. One would facilitate the use of consolidated bank and holding company audit reports. Another would allow the use of the community bank leverage ratio for determining collateral levels for public deposits. And finally, there is the clarification to the licensing exemption for bank employees. It would expand that to clarify that to include affiliates, employees of affiliates of banks. Again, we're very much in support of those provisions. With regard to House Bill 5090, requiring mortgage documents to provide forbearance rights for any borrower with a foundation in need of repair due to the presence of parasite. As we have been in past sessions, we're opposed to this. We want banks to continue to have the flexibility to address borrower situations and concerns on a case-by-case basis. We also have an issue, a concern about including provisions like this in mortgage documents that could cause a problem with banks being able to sell their mortgage loans to the secondary market. Those provisions, we're not quite sure, but might be a problem if they are present in those mortgage documents. Next, I'd like to talk to House Bill 5611, which would require property appraisals in foreclosure proceedings that only represent the interest of the borrower homeowner. That proposal, we think, will have unintended consequences for the foreclosure process. Judges in foreclosure proceedings, it appears, would not have access to other testimony or evidence regarding a home's value. We think that could lead, again, to some unintended consequences with respect to how a foreclosure proceeding would unfold and the ability to establish a fair market value of the house, of the property. Finally, CBA opposes House Bill 6323 to create a state-run bank. While there are many good goals and that have been talked about in terms of what a state-run bank could achieve, and we have no quarrel or argument with all of those goals. They're very good goals. We just think that a state-run bank is not the right vehicle to achieve those goals. As Mr. Smith from the Department of Banking testified, there have been numerous studies that have looked at state-run banks. They're expensive. There are risk issues involved, operational issues involved. We think that there is a current structure in place with community banks in particular that allows for achieving those goals by putting more resources into current programs, particularly those that are currently offered by the Department of Economic and Community Development that are being talked about. The DECD perhaps getting into. So an expansion of those programs we think would be a much more efficient and effective way of achieving the goals that the proponents of a state-run bank seek to achieve. Happy to take any questions if you have any.
Thank you, Art, so much for that testimony. Representative Delnicki.
Thank you, Madam Chair, and thank you, Art, for coming forward today with your testimony. You touched upon the state bank, and I just have a couple of follow-up questions pertaining to that based on testimony we heard earlier. Are small banks having trouble getting funds from the Bankers Bank to support loans for underserved areas and underserved people?
Yeah, that's the first I've heard of that as a concern. Loans, the Bankers Bank, in Connecticut's case, Atlantic Community Bankers Bank, which actually has an office in Glastonbury. Its CEO lives in Glastonbury. I believe he still lives there. So the Bankers Bank provides a lot of services, correspondent services, to support particularly small banks, community banks. Lending is something that they help out with, but more in terms of putting together banks as they might participate in larger loans together. But where banks don't really have problem getting access to capital for credit is the Federal Home Loan Bank of Boston, which covers Connecticut. In fact, one of the officers of one of our local banks here is on the board there. That can be an access, a source of credit for banks to support their lending activities. The Federal Reserve banks of Boston and New York also provide certain services that support banks. And that's kind of the infrastructure that I alluded to that we think is present and can be leveraged to achieve the same goals that a public bank seeks to achieve.
So if I understand what you're saying here, and correct me if I'm wrong, the issue is already being addressed for the small banks. There is not a problem with the small banks getting funding for being able to offer loans to underserved folks.
That's correct. We think more can be done in that space, and particularly through state, private and public partnerships. Again, some of the programs like the Small Business Express program through the Department of Economic and Community Development, we think those programs can be enhanced to further banks' ability to increase their lending in communities that need more access to credit.
Thank you again, Art. You made a comment to the effect that putting some kind of a forbearance provision in a mortgage document would preclude the bank from selling the paper to someone else. Is that correct?
Well, I have to confess that's a concern. I don't want to state that that's a fact that it would preclude that, but investors like Fannie Mae, Freddie Mac, and private loan investors have stringent requirements about what is included in these documents before they'll purchase a loan. So our concern is that a provision that is specific to this crumbling foundations problem won't sync up with whatever requirements these investors on the secondary mortgage market have. And as you know, as we've discussed before, I think in the first public hearing, somewhere between 60 and 70% of Connecticut's mortgage loans get sold to the secondary market, which is obviously a source of credit for consumers here in Connecticut.
Follow-up question to that. Let me back up. You don't know whether other states have put provisions in their mortgage documents that might be different from Connecticut's that would fall in the category of what you were alluding to, do you?
No, I'm not aware of other states doing that. I think, as you know, the Fannie Mae and Freddie Mac, when they purchase loans, you're generally using their forms. Most lenders will use their forms, or they'll take the form and sort of make it their own, but it doesn't generally deviate. Its terms don't generally deviate from what Fannie Mae and Freddie Mac provides in their form. So adding this kind of provision might give Fannie and Freddie pause and say, we're not going to buy that because that's not, within our, rules, if you will.
But you don't know that to be the fact, do you?
I suspect it's the case, but we'll certainly follow up on that and make sure of that. There is outside of Fannie and Freddie, there are also private investors. You would have to contact every one of them, but we think that also might be an issue for them.
One thing we've learned in the pandemic is that Fannie and Freddie actually have offered longer terms on forbearance on the mortgages during the pandemic than the state of Connecticut executive orders. Is that correct?
So the executive orders, I haven't said anything about forbearance and foreclosure. There were the voluntary programs that the banks participated in that the Department of Banking coordinated. Those have expired, but are just anecdotally and through talking to our banks, we know that I would guess all of them are still, providing accommodations, forbearance and foreclosure accommodations to their customers. I don't have any hard facts for you on that, but we haven't heard any complaints either. And that's with regard to their what we call portfolio loans. When the banks don't sell loans to the secondary market, they keep them on their books. They're called portfolio loans. And we feel strongly that banks should have the flexibility again to deal with customers that are experiencing problems on a case-by-case basis to determine what's best for the customer and the bank. And we think the history of this pandemic has shown that our Connecticut banks have done a very good job of accommodating customers and providing relief.
But do we have any statistics on that can actually prove that point?
We have not something that I can send to you readily. We have done a few, sort of informal polls of our banks, mainly before, during, and after the voluntary mortgage forbearance programs here in Connecticut, and the numbers are in the thousands of mortgages that went into forbearance, the portfolio mortgages. So we haven't kept up with asking for more data in that, but that's something certainly we can try to get a little bit better of a handle on for you.
Yeah, I'd like to know that from the standpoint that anecdotally I've heard from a number of folks in my district that have had problems with trying to get the forbearance, and it took a little perseverance to make that occur. And I got to send this to you, New Jersey Assembly Bill number 5096, close number oddly enough, June 17th, 2019, where they actually extended and created an extension of forbearance for folks that were victims of Superstorm Sandy.
I haven't seen that. I'd be happy to take a look at it if you want to provide it to us.
Yeah, I'll have to get that to you. Finally, and this is an issue that's near and dear to my heart and probably also my co-chair, the co-chair Representative Doucette, is notification on closing of branches, bank branches, as that impacts various communities in a deleterious fashion when all of a sudden your local bank is closed. How can we get better communications short of passing some kind of legislation that compels the banks to notify a community that, say, a year, 6 months from now, they're going to be closing branches?
Well, right now, and it's been a little while since I was in private practice and working on these matters, but when a bank decides to close a branch, it has to notify its customers. I believe it's 90 days under both federal and state rules. So that, like I said, that notice has to go out 90 days prior to every customer of that branch. So that notice requirement is in place. I processed a number of help from a lawyer standpoint, a number of banks closed branches over the years, and that process seemed to work for me, for them. I don't recall, there being a lot of concern or backlash. Typically, these branches are being closed because there's another branch very close by. The branch is underperforming financially. There are a variety of reasons, but it hasn't seemed to be seemed to me anyway, just from my own experience as a lawyer, to be a problem. But it's not. I'm aware that I think that there's going to be a bill proposed. Maybe there already has been. I haven't seen it yet, but that's something we're certainly going to be giving more thought to, and we'll have, I think, more comments for your thoughts on that subject when it comes up.
One more follow up, and then I think I'll turn it back to the two chairs. You spoke to banks notifying their customers within 90 days of a branch closure. Is the customer defined as, or let me rephrase that, how is it defined as to what customers are going to receive what kind of notification? Is it done by the distance? If I say had an account at ABC Bank and I live 10 miles away, is it determined by distance, or is it determined by where you actually open the account?
It's determined by where you open the account. So the customers of that bank would be generally known. That opened an account at that branch would be identified with that branch by the bank, and a notice would go to them. There's also lobby posting requirements that have to go up in the lobbies of these branches that say that we're going to be closing on X date. So there is that notice as well.
So then, if I lived in South Windsor and I originally lived in, say, Summers, and I opened my account with the bank in Summers, then moved to South Windsor, I would get a notification if they were closing the Summers Bank, but not if they were closing the South Windsor branch?
I think that's right. I'm not a banker, but I don't think that your address move, unless you moved your account somehow to that other branch, I don't think that's how it works. But if you opened your account at that branch, you should be receiving a notice, the notice 90 days prior to the branch closing.
Yeah,
I can certainly.
I'm just going to interject for a moment, because Representative Delnicki, we have a bill to this effect, and it's scheduled for a different public hearing. So
sorry,
I don't like to interrupt you, but perhaps we could table this conversation for that public hearing.
I'll be more than happy to, Madam Chair. I was just trying to wrap my arms around the issue.
Okay. Well, it is.
That's the sum total of my questions. Thank you.
Well, thank you. Thank you so much, Mr. Corey, for your testimony on these various subjects.
No.
I do not see any other hands raised.
No.
So
Yes, you do.
I do. Oh, Representative Ziogas.
Yeah, thank you. Yeah, Mr. Corey, hi. When I was interested in HB 5611, and we were talking about the appraisals. Can you describe for me what happens in a foreclosure in terms of the judicial process and how they engage appraisers?
Yeah, absolutely. So I'm not a foreclosure attorney, so I'll give you my understanding of it, and I think this is correct. So, in a foreclosure proceeding, an appraisal is going to determine the difference. Whether there's going to be a strict foreclosure or foreclosure by sale, and it also helps to determine whether there is a deficiency that's going to be owed to the lender. So it's a very important part of the process. And as I understand it right now, either party to the foreclosure, the lender or the homeowner, can obtain an appraisal and introduce it as evidence in the foreclosure proceeding. And the court ultimately will have to, determine what the fair market value of the house is for, again, those important reasons of the type of foreclosure and whether there's a deficiency. So this bill seems to me what it would do is say that there's only going to be one appraisal that the court can even look at, and it's going to be one that is represented by the interests of the borrower. A problem related to that is that right now appraisals under both Connecticut and federal law have to be impartial. So I don't know what it means to say that you have to have an appraisal that's representing the interests of the borrower, if that means that appraiser is expected to sort of take the side of the homeowner, which again flies in the face of the standards that appraisers operate under and have to operate under by law. So a very important piece, and I think courts, from what I understand, like to have as much evidence as they need to establish that fair value of the house.
Yeah, it was my impression that the code of ethics in the appraisal industry was such that they were supposed to be somewhat unbiased. So they come in with some independent information.
Yeah, and those code of ethics,
both sides appreciate the difference.
Right, and those code of ethics are mandated by federal law and state law.
Okay, so it wouldn't be atypical for the homeowner or the bank to come in with their separate appraisals?
I think again, not a foreclosure lawyer, so but from what I've heard, I think oftentimes it's the lender that picks up that cost and provides that service, if you will, to the court by obtaining that appraisal and having it introduced as evidence. But the homeowner is free to get their own appraisal and introduce that as evidence.
And just one last question to that issue. There's usually minimum qualifications to be qualified to be represented in the list that the court maintains, I would think. Appraisal credentials. It's
right.
Not just anybody. It's just any appraiser.
Right, and there is a state licensing set of statutes that again point to those industry standards that include impartiality that all appraisers have to abide by. So absolutely, licensing and standards are very much in place for appraisers.
Okay, thank you for your responses. Thank you.
Sure thing.
Thank you, Representative Zayugas. I just wanted to apologize. I did not mean to ignore your hand. I can't actually see all the members at the same time, but I can see the list of panelists. And if you use the raise hand function at the bottom of your Zoom screen, there's a little button that says raise hand. If you use that.
I'm just going to practice for a second, okay?
Okay, let's do that. Yeah.
Does that work?
Yes.
Okay. All right. Thank you.
Excellent. Great. Thank you. I promise you will never be overlooked again because now I can see it. Thanks so much, Representative Zayugas, and thank you, Art. I do not see other raised hands, so thank you again for your testimony.
Thank you.
And we are going to move to Sarah Porras, who I believe is with us.
Good afternoon, everybody. Thank you, members of the committee.
Sarah, welcome.
Once again, letting me testify. I'm here today to testify in support of Bill number 5090 related to mortgage forbearance when homeowners have a crumbling foundation. I did submit some written testimony. I'm not sure if there are any other members who have questions for me. I'm a solo attorney in West Hartford, and I work with homeowners in foreclosure, so I may be able to answer some of those questions that came up a few minutes ago. And I work with homeowners who have crumbling foundations because often they choose to walk away from their homes, and this bill would, if there's a clause written into mortgages and if other lenders start to follow suit, and a lot of people with crumbling foundations, they've had their mortgages for years already, so this wouldn't necessarily affect them directly unless their lender decided to also give forbearances based on the diagnosis of the crumbling foundation or the decision to repair the foundation. So not a lot of homeowners are getting the money to repair, but those who are finding themselves homeless for a few months I've seen people moving into an RV on their property, which would not be ideal for everybody. Not everybody has access to that, so they usually have to pay for housing expense elsewhere. And this would relieve that. The big question I'm seeing is, but how will I afford that? How will I afford to continue to pay my mortgage while the home's being repaired and pay to live somewhere else? So I think this would be a fantastic start in the direction to helping those homeowners.
Thank you, Sarah. Representative Doucette.
Thank you, Madam Chair. Hi, Sarah. Good to see you again. Always valuable to hear your experiences and stories. So I guess I would ask the question, have you had any direct experiences with this scenario, homeowners who have a crumbling foundation, perhaps have received the CPSIC funding, are moving out of the house, and what types of conversations what kinds of responses are they getting from their lenders? Have you had any success in convincing a lender to enter into a forbearance?
I have not had the opportunity to work with someone who's facing this. Most of the time when they're on the list to get the money and they're about to go, about to get their house raised and their foundation fixed, they are not speaking with me, actually. I'm not working directly with anyone who's that far along in the process. My role to date with a few dozen homeowners has been to counsel them because they aren't going to get the money, because we know there isn't a lot, and it's all spoken for, and they don't know what to do with their homes, and I walk them through some options. I know though that a lot of homeowners who are considering stopping paying their mortgage because they have a crumbling foundation would like a break, right? And that's what this bill would provide. I don't think it means you have to have your home being repaired to get the 4-month forbearance. You just need the report that you have the problem and you can take a 4-month forbearance. And that gives homeowners an opportunity to save a little money that they're losing because they have no equity. We understand what the problem is here, that when you have a crumbling foundation, nobody wants to buy your house, so you don't have home value anymore, yet you still owe the full amount of your mortgage. That allows a homeowner perhaps to choose to take a 4-month break, put that money in the bank. And I think every homeowner I've spoken to with a mortgage, they want to do the right thing. They want to pay their loan. They just want a solution that's fair for everybody, and this helps.
So I guess then I'd extend the question. So in that scenario, where you have a homeowner who's in default, is not participating in the program, or has other distress, what have those experiences been like? Have you had any luck with lenders? And I asked just because if there's a way that we could find sort of a model or a scenario that may be workable in the experience of a mortgage lender. Have you had any success? What are your best success stories with getting a lender to either modify or forbear?
None with forbearance. Again, I haven't worked with anybody who's facing the repair, so I haven't worked with someone to help get their lender to give them 4 months while their house is being repaired. But it would be but modifications would be great. I think mortgage. I think one of the things proposed, and we don't want to go way too sideways on the crumbling foundation issue here, but I certainly could. So stop me when appropriate. But the another idea is for the lender and the homeowner to sort of be business partners in this. The lender needs to realize the home value has gone down. The homeowner often wants to stay. A lot of these homes are livable. There's nothing wrong with them. Some are really in rough shape. Some are falling apart. Some are fine. Some may be fine for 10 years or more. And the homeowner wants to stay, wants to continue raising their children there, and doesn't want to uproot themselves from their community or have to find a new home. And certainly not if they're left with mortgage debt, right? If they try to move and they can't sell for what their debt is, they will be left with the debt. They're forced to stay. This also affects just the normal movement of our workforce, people who grow out of their homes. I'm seeing a lot of that. People who buy a condo or a home as a first starter home, and then they have 2-3 children and they grow out of it. They want to naturally move like anybody else, but they can't. People change jobs and they need to relocate and they can't. So if the lender said, okay, we understand your house used to be worth 200, now it's worth 100, and you owe 200 on the mortgage, we'll go in on this with you, we'll work with you, we'll reduce the principal. That would be ideal. That's where I'm going with this, is if the lenders just understood they need to take a loss, just like the homeowner's taking a loss, because the homeowner doesn't have that equity that they expected they would have after paying their mortgage month after month.
That's certainly, I think, would get at the issue. But you know, and last question, if you have any thoughts, maybe a little outside of your wheelhouse, but on the regulatory question in terms of how we can reach the GSEs or federally backed mortgagees and get them to participate in such a program. If you have any thoughts on how to address that issue, which is always an issue for us.
Well, I think through our senators, that's probably, that's what they, you know, when they come and speak to groups of homeowners, they emphasize that it's a state issue and they are the federal mouthpiece, you know, for that. And so unless we have requests that could be handled on the federal level, such as Fannie Mae, Freddie Mac, and FHA, if that's what you mean by GSE, we need their help. We need to get those agencies on board and more aware, and then to work with homeowners.
All right. Thank you. Thank you, Madam Chair.
Thank you. Thank you, Sarah.
Thanks very much.
Are there other questions for Sarah Porras? Seeing none, thanks so much for giving us your testimony today. And we are going to move on to Eddie. I don't want to mispronounce your name. Aguiman?
Adjaman.
Adjaman.
No worries.
Sorry.
Yep. Thank you.
Welcome.
And thank you. And thank you, committee members, for giving me the opportunity to testify for bill number 5610. So I'm in support for this bill because it helps people in that age not take out so much debt that is not high in interest. Student loan debt is the second highest consumer debt category. And with the job market being competitive as it already is, and people being laid off because of COVID reasons, these low interest loans can help young adults want to pursue a college education. When people finish their undergrad, they will need income to support paying off that student loan. If they cannot find a job to support that and tackle debt, it will hurt in the long run. As the high interest keeps accruing, another thing to mention is the time it will take to pay off. If a student borrower has a high interest rate in a loan, this can make monthly payments less affordable and make the amount of money owed back to that lender astronomical. That may also mean less of the payment going back to the principal of the loan. With a low interest loan, this can help the student loan tackle debt faster. Low interest loans also help with other expenses that need to be met as well. For example, rent. If a student needs to pay for rent after finishing their undergrad, a high interest loan will not help them. Rather, a small interest loan will be better for them and can help pay that bill towards rent. Though this is a solution that can help, the bigger problem, of course, is the higher cost for education, as the money taken out for loans to complete a 4-year program is ridiculous and I hope to be fixed soon. That is all I have for my testimony, and I'll allow any questions.
Thank you, Mr. Adjaman. Let's see if the committee has questions. Well, I'll just ask you, is this something that you have a experience in, either personally or professionally? Like, where does your knowledge, what informs your knowledge on this issue?
Oh, it's no problem. I'd love to share that. As a recent graduate, I graduated from Quinnipiac University from 2019. I had about 80,000 of student debt racked up right there. And just seeing not even having a job after college, even just finishing it, it was something that just pretty much scared me. And just thinking you have that 6-month grace period to actually have to start paying those loans, it was something that probably I can't even meet. So in my head, I'm rushing to think that I need a job just to make sure I meet ends meet to pay that loan. And of course, pay any other debt that I do have, whether that's credit cards or a car payment that I'm making as well. So these so I know I had high interest loans that I'm still paying off, and even trying to refinance those loans, I don't have enough good credit buildup or enough good credit history to make sure I can get that good refinance that I want from another lender. So it's a tough game to play, and it's something that I'm currently struggling with. But as a aspiring financial coach and counselor, that's my passion, really wanting to help these people in understanding that there's other ways, approaches you can take to actually pay off these loans or even get a lower interest rate loan, therefore, and dare say.
That's great. Thank you for sharing that with us, and that you've taken your personal experience and made it into a way to help others by coaching them financially. I just wanted to let you know that you may already know this, but we did take a first step in this direction 2 years ago. We passed a law that would allow Connecticut employers to get a tax break for helping to pay down student loans for people who graduated from college in Connecticut or graduated elsewhere and are now working in Connecticut for 5 years. And it's through CHESLA. So even if they have a student, high interest loan from another lender, if they refinance through CHESLA, they can get the benefit of this. The employer gets the benefit of the tax break, and the person, the individual, gets the benefit of their employer helping to pay down the debt. So I know it's not a complete solution, but it is, I think, a very significant thing that we were able to do. But not that many people know about it. So I hope that's something that might help you or the people that you advise. And if you have any questions, you can email us, and we're happy to answer it later.
Thank you so much, Senator.
Thank you. Does Representative Ziogas?
Yeah, I raised my hand properly this time.
Yes, you did.
There you go. Eddie, if I can call you Eddie.
Of course.
One of the questions that keeps coming up in my mind whenever I hear everybody talking about student interest and student debt is personal responsibility. And, and we go, and I'm on the higher ed committee, and we're entertaining this in terms of trying to educate the borrower before they take out the money as to what the cost of education is, what how do you pay it back? You're coming out what you claim to be $80,000 worth of debt. And that's a lot of money. I understand it's hard to deal with. But when we started out on this process, what were you thinking that the end result would have been?
So me, my parents, of course, come from are immigrants and come from Ghana. So when you have immigrant parents, they really want you to go to a prestigious school, go to college, and want to finish those 4 years. And so having that pressure, that social pressure right there, is another factor. And even having that peer pressure as well of seeing your other friends, go to these other type of schools, and you think in your head is that I need to do this no matter what cause, or I'll end up being a failure to my family and of course my friends and my competitors. So that's something that probably goes through my head. I know through most students' head of trying to take out these loans, even though they're bad for them. I do know community college is an even less expensive option, but that's even a downside of something that people even look at, just because it's not even as prestigious as the other schools that people do look at.
Yeah, I can understand probably some of what you're saying, but coming through the public school system and financed my own way through college over the years, I have to say there's got to be some individual responsibility here, and we can't take care of everybody that comes out with debt. Although I am certainly in favor of lowering and subsidizing interest rate on debt. Debt forgiveness I'm not crazy about, but hey, that's something else. But as part of your educational process, I think you need to be open to advising people other than maybe people of your background that the community college system is available, affordable, and leads to a good result. So that's part of your training. But I still think we need to step back a little bit and start putting some responsibility back on the borrowers here. And we can't relieve everybody of that responsibility. But anyways, that's just my thought. Thank you.
No problem. Yeah, no, I completely agree with that statement as well too. Just because it's something important, like you said, is a personal responsibility that someone has to look through that fine print and see if that's even a good loan that they can secure or even pay off in those future years, of course. I think this stems to the point of that, we need personal finance courses in high schools, even down below that, where we can teach these people that are going through the youth to understand and say, hey, this is a bad loan for you to take because it really doesn't fit your income or, future income that you might project. So I feel like, personal finance courses will be something that's pretty enlarged, that something that's going to have to be implemented. And of course for the parents too, but I do agree with your statement.
Okay, thank you.
Thank you, Representative. And thank you, Mr. Ajiman. We have to, I'm sure we all believe in personal responsibility. I know I do, and certainly you do. We also have to note that college tuition has increased dramatically, in the last generation. So it's not the same set of circumstances that existed even 20 or 40 years ago. So it's a much, much higher financial bar, and and it is. Financial literacy is our responsibility to teach at a much earlier age, so that we can help people be more prepared and avoid situations which end up being catastrophic for them. But I applaud you, Mr. Ajuman. Thank you so much for coming forward, sharing your testimony and your experience with us today. Thanks so much. Oh wait, we have more questions. We have more questions. Representative Doucette.
Thanks, Madam Chair. And thanks, Eddie, for coming today. This is exactly why we have these hearings. It's great to hear your experience. And I know it hasn't been easy for everybody finding us on Zoom and everything, but nonetheless, it's great to see you. One question, and I don't want you to share your whole financial history, but I'm just curious, are you familiar with CHESLA? Have you looked at applying for a CHESLA refinance loan? Because that's the piece that's important for us. The bill is directly related to the CHESLA program, which, as Senator Kasser alluded to, is something that it works quite well and is perhaps even underutilized, and it's something that we want to encourage the use of. But so the question is if you are aware of CHESLA and have applied to CHESLA.
Of course, Representative. I have not heard of CHESLA at all, probably because I believe it's probably not advertised as much as it should be. And that course could be, of course, the other competitors just have much more money to market themselves and advertise, but I have not heard of CHESLA.
Okay, interesting. Thank you. Good to hear from you again. Thank you.
Thank you, Representative.
So CHESLA is the Connecticut Higher Education Student Loan Association, and that is, I don't think it has a marketing budget, which is why a lot of people may not know about it, but this is why we're telling you about it and anybody else who's listening. It is a state-sponsored entity whose mission is to help students get low interest financing for their education. So, okay, we have Representative Borer has more questions.
Thank you, Senator. And thank you, Eddie, for coming and testifying. I think it's great. If you could navigate our system and get in, it's half the battle. Question for you. So before you went to school, besides the information and the handouts that the school gave to you, how would you have learned about what your financial options were? Are there community service centers? How do students find out what grants are available, what loans are available besides that form that they give you when you're applying?
I'm trying to remember back all the way to high school. I'm sure that if you need any type of grants or scholarships, you would have to go to your guidance counselor in school, and they would direct you to some sort of websites that do advertise these grants or scholarships that you could apply to. But as for something that was really advertised and such to where you could just go and apply, I don't really believe there was really none during my high school days.
Yeah, so what I'm getting at, and I wasn't necessarily referencing scholarships, right? Because those, yes, your guidance counselor should be letting you know about. But my son is a sophomore in college, and students are 17 when they're going into college. So sometimes students don't grasp exactly what that loan's going to be at the end of the term, right? As much as you get that information, you're excited to go to college, you want to get an education, I don't know sometimes that it's all sinking in what they're going to have to pay on the back end. And I do know that when you apply, because I helped them with the application process, that you receive, a lot of information from the school. Here's your opportunities. Here's the Pell Grant. Here's how this works. But it would be great if there was free, we probably don't want to hear this, but some free counseling for families to go to, I searched, to try to navigate what the processes were and what the financing was. And it was difficult for me to find a place to go where somebody works in this every day and they could educate us as a family on what the options are. So, I mean, I know we have Chelsea, I know we have Pell Grants, I know we have all scholarships, but somebody who really brings it all together and brings it home for a family so they really understand what the options are. Do you find maybe that's missing?
Yeah, I do find that that's missing because, of course, when you're, like you said, you're a 17-year-old, you really don't know what you're doing or going through when you enter college, and you're really not thinking that high-end college payment they have to make once you graduate. And not even thinking about, job market after that. So a counselor of some sort that could just come and just meet with each person before they actually go and borrow some money would be a great idea, just because they could show them the realities of what would happen if they take out that loan. Just give them, financial projections of how their life would go with loans or whatnot. So that's something to really consider.
Yeah, or even the parent who's trying to help that 17-year-old, right, that's entering college. It was my first time navigating the system as a parent, and I found it very difficult to understand what the options were. So I'm glad you brought this to our attention, because I think that, and that might be something for higher ed, but since we're in banking, I think, a free opportunity for families to be educated would be great.
No, I agree. Thank you. Thank you so much, Rob.
Thank you. Thanks.
Thank you, Representative Boer. Are there any other questions for Mr. Agyeman? Okay. Seeing none, we thank you so much for coming forth and sharing your experience with us.
Thank you so much, committee members.
Take care. And now we're going to move to John DeLorio.
Good afternoon, committee members. Can I be heard? Excuse me.
Yes, yes, you are heard and seen.
Okay, great. Thank you. So I submitted my testimony, which is pretty comprehensive, and I think rehashing all of it is probably not the best use of anybody's time. So the few things that I would point out from 30,000 feet, if you want to ask some questions, are the following, which is, this governor is very committed to regional practices for purposes, especially business purposes, consistency. And there is not another New England state that currently regulates this particular legislation as Connecticut does. The second important issue here is to make sure that we create equal protections for all consumers that get a mortgage in Connecticut. The last broad data that would be available is the 2018 NMLS report, which will show you that Connecticut had 15,347 loan originators. 9,183 of those are mortgage loan originators that work for non-depository institutions, and 6,164 of them are registered mortgage loan originators that work for banks. Of those 15,347 licensed individuals or registered individuals, over 5,000 of them did not originate a single mortgage loan in the year 2018, which means 1/3 of the licensees didn't even do the regulated activity. And if you were to look at the 32,000 or so mortgages originated in Connecticut in 2018, that would mean that your average loan originator in Connecticut does 2 units a year, which of course would be impossible to make a living and survive. I have vast experience as a mortgage servicer and can answer many of your questions that you've been posing about forbearance. Shared appreciation transactions are not just like second mortgages. They're nothing like a second mortgage. If you'd like more information on that, I can give you more. And the whole lead generation discussion that happened early on here, I would like to point out a couple of things about that. First of all, investment advisors are not registered as lead generators in Connecticut. As a matter of fact, investment advisors are mortgage loan originators, registered mortgage loan originators in Connecticut, and I know that to be a fact. And if you were to look at the reports as of today, Connecticut has a total of 3 lead generator licensees. I appreciate the testimony given earlier today, but I don't think it's exactly how 1738 came into play. And I'm getting a note that my time is up, so I will stop there.
Okay, thank you, Mr. Delorio.
You're welcome.
But I believe we do have some questions for you.
Okay.
Representative Doucette.
Thank you, Madam Chair. Thank you, Mr. Delorio. Wanted to give you the opportunity.
I'm sorry to interrupt you there. It's Diorio with an I.
Diorio.
It's a font thing.
Okay.
It makes the capital I look like an L. So.
Okay. Thank you.
You're welcome.
I wanted to give you the opportunity just to clarify. I did look through your testimony, and there's a lot here, and I appreciate as a professional in the industry that you probably have a lot of knowledge and thoughts. So I just wanted to give you the opportunity to sort of distill, if you were, what changes do you think specifically to this bill? We're talking about 849. That would you suggest that we look at? I understand shared appreciation. You would seem to suggest that we try to eliminate that practice or prohibit that practice. What changes would you like to see to the lead generator provisions and anything else that you have comments on?
All right, so on section 45, I think it's incredibly important that you define what an application is under the Connecticut SAFE Act. I don't know if you took time to look at the advisory opinion letter that was written in 2016. It's gone through a tremendous amount of legal analysis by people that are much smarter than I am, and it's just legally wrong. And honestly, 1738 is probably more of an attempt to fix that than anything else. Time will tell on that one. But it's my personal view that unique identifiers are incredibly important. And the reason that unique identifiers are so important is it allows people to track exactly what happened on a mortgage, which was lacking in 2008 and led to a lot of the misbehavior that took place. It also gives a public sharing a database that's readily accessible to consumers, so they can go in and check any mortgage loan originator or any company or any broker or any lead generator to see what their history looks like, how long they've been in the business, do they have any regulatory actions, stuff like that. So unique identifiers are critically important. But I think we can agree that having 15,347 mortgage loan originators to originate 32,866 loans, it doesn't even make sense, especially when 5,000 plus of them never originate a loan at all. So if they're not originating loans, I'm not sure how you can bridge to a mortgage loan originator. If they are providing data that is associated with a mortgage loan, if they're putting themselves into the data process, then of course they should have a unique identifier. And that unique identifier will allow not just regulatory agencies, but the mortgage lender itself, which is where I have specific experience, to be able to track back any bad action. My former company used something called a byte data log that did the same thing internally. But it should be available to regulators. So if you have 5,000 mortgage loan originators that are not originating mortgage loans at all, and of the 10,000, the vast majority of them only write a handful. If that swath was covered by the lead generator statute by eliminating the exceptions that I redlined out of the bill, then you could shift that unique identifier to a process, as Matthew explained earlier today, would lift regulatory burden, ensure that the unique identifier is actually in place for everyone who touches the loan. And most importantly, 6,164 of these residential mortgage loan originators don't have any pre-licensing education. They don't have any continuing education as somebody that would work for a non-depository institution does. So what gets really complicated as this plays out forward is it contradicts Dodd-Frank. Dodd-Frank requires that loan originators, it's even a third term, are qualified, properly trained. There's a list of things that a loan originator under Dodd-Frank needs to, some boxes you need to check in order to stay in line with that statute. Connecticut's current administration of the SAFE Act is just in conflict with the Dodd-Frank Act, which traces right back to that 2016 advisory opinion letter. So if you adopt a Dodd-Frank definition of application, you're going to align the statutes, the federal statutes with the state statutes. You're going to streamline your regulatory process by moving a bunch of people who aren't really mortgage loan originators into the lead generator slot. And you're going to take your number of mortgage loan originators down to a manageable number that you can actually regulate, all with just a few very minor tweaks. The other really important thing about the application of definition is consistency with the surrounding states. We're way on an enforcement, from an enforcement perspective, we're way on the other side of what is accepted by every other state in the region.
So just one follow-up on that. How would we implement a unique identifier program, and are there other states that do it?
NMLS is all about unique identifiers. The whole purpose of lead generator, the whole purpose of mortgage loan originator is to make sure that people have unique identifiers. And I think a while back, Connecticut rightly tried to expand that scope a little bit to include people who really weren't mortgage loan originators. But what they originally did was just took a bunch of people who aren't mortgage loan originators and throw them into the mortgage loan originator bucket. I mean, think about that. 33% of your mortgage loan originators don't originate mortgage loans. It doesn't. And
again, do other states have a different program or implement a unique identifier?
Yes, it's called the Model State Law. So the Federal SAFE Act was passed in 2008 as part of the HERA bill. And it was a federal act that started mortgage licensing in effect. They created minimum standards that the states have to follow. From that, the states got together and drafted something called the Model State Law. And it's exactly as it sounds. It was designed to create consistency in regulation and enforcement across all the states so that you could operate in more than one state. So the Model State Law has been adopted in 38 states, including Massachusetts, including New Hampshire, including Vermont, Maine, Rhode Island, New York. It's standard legislative text. Takes an application and offers and negotiates terms.
And so in those states, under that model law, you get a unique identifier, sort of like an MLS. Is that the way it works?
It is the NMLS. It's the underlying law for the NMLS.
I see. Okay.
The SAFE Act created the NMLS on a federal level in 2008.
Okay.
So if our laws are being administered so differently than the surrounding states, if an MLO from a surrounding state comes into our state to originate, and as the text is written now, both the lender, which has their own unique identifier, and the mortgage loan originator, and any control person that is in between those two slots is legally responsible that Connecticut laws are followed. But if you're coming in from Massachusetts and you're following the way Massachusetts implements and enforces the law, in Connecticut, you're going to run afoul, because the way it's being enforced and the way that it's drafted are starkly different.
Okay. Well, thank you. That's helpful. Like I said, you gave us a lot of information, and certainly helpful to learn a little bit more about this, and like I said, it helped to sort of distill it down. So I think that's all I have. Thank you.
You're welcome.
Okay, thank you, Mr. DiOrio. Apologies for the earlier confusion about your name. I do not see any other hands raised, so we thank you again for coming to testify.
You're welcome. Have a great afternoon.
You too. And we are now moving on to Bruce Adams from the Credit Union League of Connecticut. Welcome, Bruce. Is Bruce with us?
I'm here now. Can you hear me?
Ah, yes. Now we can hear and see you. Welcome.
I have 2 mute buttons just to be extra sure. Which, by the way, is good counsel that I keep for myself. I actually do have 2 mute buttons. Senator Kasser, Representative Doucette, Representative Delnicki, members of the Banking Committee. My name is Bruce Adams. I'm the president and CEO of the Credit Union League of Connecticut. And in accordance with the rules, I would like to state up front our position on certain bills, just for ease of your tally. With respect to House Bill 5610, we oppose it as written. 5611, we oppose. 6323, we oppose. We express no opinion on the others, except I would add that with respect to House Bill 5090, we oppose only on the basis that credit unions by design offer flexible and compassionate accommodations to borrowers who are having issues with their loans, and so we view it largely as unnecessary. And we also consider the fact that because there is no further instruction around when those forbearance payments should be repaid, how they should be repaid, how the lender can ensure that the borrower continues to have the ability to repay, all of those things are open questions in that bill. We're not saying that those can't be solved, but flagging those as issues for the committee. We're coming to the end of a relatively long and dense hearing, so I will leave my written testimony mostly to stand on its own, but I will flag for you a few items. First, as many of you know, but I will remind the committee that as not-for-profit financial cooperatives, credit unions employ a unique business model. And that model returns the profits, if any are made, directly back into the pockets of the members, which is a very different business model than your standard financial institution. As a result, the leadership of a credit union, the staff of a credit union, has a vested interest in the financial health of those members, of those customers. So earlier in the hearing, when you hear people talk about where can I go for good financial advice, or I wish I had more transparency in such and such transaction, my now standard response is, well, which credit union are you talking to? And so, those are all valuable options for people and for your constituents. So to the extent you have a constituent with a certain financial challenge, consider reaching out to the league, and we can hook them up with somebody that's local to them. With respect to 5610, I would put an additional piece of context on that bill. That's the student lending bill. It references the possible creation of a revolving loan fund. And this is a theme that has woven its way through this hearing today, and frankly, through some other hearings, specifically in relation to even crumbling foundations, that we think as credit unions that one of the best uses of public dollars. I'm already past 3 minutes. Normally I hit it right on the head. I will briefly summarize. We believe that the best use of public dollars is to put them out in the form of loan guarantees and other programs that allow the private lenders to leverage their private dollars. And leverage that means that leverages the value of the public dollar. So with respect to student lending, if you look back to 2009, there was a Governor Rell program to refinance student loans in partnership with the Credit Union League of Connecticut in exchange for a partial loan guarantee. And that program resulted in no or virtually no defaults and leveraged the value of the state dollar by something like 20 or 30 times. And finally, with respect to references to banking deserts, this is a league priority for us. And to the extent that any of you have identified a banking desert that needs services, we invite you into conversation with us about how we might help. And with that, I'll take any questions.
Thank you so much, Bruce. Did that program that you just referenced, did that lapse? What happened to it?
It lapsed. I believe it was a $3.5 million program, and virtually all that money was put out on the street and paid back.
Thank you. Okay, Senator Berthel has questions.
Thank you, Madam Chair. Bruce, thank you for coming before the committee again today for the public hearing. It's always good to see you and to hear what our credit union is doing. I'm, in the interest of full disclosure, I'm a little biased. I'm a former credit union board member and employee, but I think that what you just spoke to, and I don't know if you can elaborate on a little more with regard to that former program under Governor Rell. If I'm understanding you correctly, that probably reduced by putting that out into private investment, and private investment meaning not the state of Connecticut, right? We reduced the overall expense for the state of Connecticut for bonding and other ways that we borrow money to help steady the ship financially. So do you see, obviously you testified and stated the league's position on a number of different bills, but do you see an opportunity? For that kind of arrangement or plan to happen again? And is this a good market for it, given what we know? Banks and credit unions, not only in Connecticut, but nationwide, are sitting today on large piles of money, figuratively, because lending is down because of COVID. I mean, is this really a great, I don't want to say once in a lifetime or is it just a great opportunity for us to really be thinking harder and engaging other constituents within the state government and possibly for Chesla as well, to get everyone to the table again and do something with this? And I know I threw a lot at you. I'll let you respond and stop talking.
Well, no, sure, Senator. Thank you. Yes, is the short answer to your question. This is a good time to help financial institutions, whether they be banks or credit unions, to put their money to work, because as we all know, when dollars flow through a system, that's when the economy gets healthier. So when it doesn't move, the economy stagnates. In this case, especially when you consider if the state didn't have to bond, or let's do it a different way. If the state only had to bond 1/10 of the financial power they wanted those dollars to have, that's obviously better for the state fisc, and it helps the private lenders put their money into the system. With respect to credit unions in particular, because we offer free financial counseling and free advice, and as a closed financial cooperative, closed in that the deposits from the member form the capital for the loans they lend out, they're very invested in getting a healthy and independent member. But we are also lenders of last resort in many cases. So we're bringing in people with financial challenges and helping them overcome those challenges. And so for us, this is an ideal opportunity. If we just had a little bit of guarantee or comfort from the state, we can actually help the people who have the low credit score to buy a car to get to their job. We can help the the victim of domestic violence get enough capital to, move out and become independent. We can help the young student access credit in a way that, God forbid, is dischargeable in bankruptcy if that had to happen. So these dollars are in our financial institutions waiting to be used. And with a little extra comfort from the state right now, we could, I think, find a more mutually beneficial relationship.
Thank you, Madam Chair. If I may just follow up on that real quickly. So, Bruce, I think that's a very interesting concept. I've been listening all day, obviously, to some of the comments being made and testimony provided regarding loan forgiveness and whatnot. And earlier, Representative Zioga spoke to that he's not a big fan of forgiveness necessarily, and neither am I. But I think that if we have an opportunity to work with our credit unions and banks in Connecticut to develop something that maybe is completely new, maybe it's a rehash of that plan from a decade ago, and to actually help people to not only be able to be responsible, because I think that's part of why you go to college in part to learn responsibility along with your skill and whatever whatever subject matter you're pursuing, and ultimately a career. But if we can help to teach responsibility, financial responsibility, and we've had some discussion earlier today about about having to bring financial literacy even further lower grade levels, into 7th and 8th grade. Forget about just high school. I think there's we could be a really great opportunity. Maybe we become a model for the rest of the nation ultimately, to say, look, we're not looking to give education away. We're not looking to just put lenders in a really hard spot to have to recover from. We're trying to find out a solution that works and keeps the economy alive. It keeps our students, who are young adults generally, responsible. They understand their sense of obligation. I think there's a lot of really good things that could be discussed here. And I thank you for bringing this reminding us of what was done a decade ago. And I think the committee has some really good things to think about as a result of your comments today. So thank you for that. Madam Chair, thank you. I appreciate a few extra minutes just to comment on this. This is kind of exciting, actually, for me.
It is exciting. It is exciting, especially when there have been good ideas in the past, and maybe we don't need to reinvent the wheel. Maybe we can actually just revive good ideas. So let's do some more exploring of that offline and continue this discussion amongst ourselves later. But thank you so much, Bruce. I don't see any other hands raised, so we will let you go. Thanks again.
My pleasure to testify. Thank you.
And now we have our final person who has signed up. Jeff, are you? Yep, there you are.
Hi, good afternoon. Thank you, Senator Kasser, Representative Doucette, Senator Berthel, Representative Delnicki, and other members of the committee. My name is Jeff Gentis. I'm with the Connecticut Fair Housing Center, and I co-supervise a clinic at Yale Law School. I had submitted 2 different pieces of testimony. One was on House Bill 5090, the Crumbling Foundations Forbearance Bill, and the other was on the Senate Bill 849. That one's quick, so I'll cover that. There's Section 12 of that bill. That was the department's bill. Section 12 was what Matt described as applying the department's supervision and licensing regime to people who purchase tax lien debt. There's been I think allowing municipalities to sell tax lien debt has posed a lot of problems, but one of them has been the lack of regulation and supervision over the buyers. So this helps close some of that gap. The second on House Bill 5090, and Representative Delnicki spoke to this earlier, but in the course of working on COVID relief ideas in the mortgage market, we came across what New Jersey has done in the aftermath of Superstorm Sandy, and it's been a way to provide for forbearance across the board, including in existing contracts for existing homeowners. And it might be something that's worth exploring here. I had only been thinking about it in the COVID context, about thinking about ways to help people affected by the COVID pandemic here. And it was only couple days ago that I said, oh, let's make the connection with the crumbling foundations here. It's a similar type of natural disaster. That being said, the 5090 is a good bill. I think it provides some certainty for both someone who wants to refinance and for somebody who is looking to purchase within the affected towns, that if for some reason something doesn't show up on an inspection, they'll have some options down the road for forbearance, if nothing else. And with that, thank you for your time today, and thank you for allowing me to testify.
Thank you, Jeff, so much. And thank you for your work every day. We have questions by Representative Delnicki.
Thank you, Madam Chair. And Jeff, thank you for coming out today, or actually zooming in today with your testimony. And when I took one look at your testimony on 5096, the New Jersey bill, my obvious question is, from a legal perspective, can we actually implement that here in Connecticut?
I don't see why not. And I can talk to my peers about what their experience has been. My impression has been from talking to them, albeit without this context, that they have been able to get the federal agencies that are a big problem in getting some of these crumbling foundation mortgages worked out, particularly with respect to principal reduction. Fannie Mae, Freddie Mac, FHA have been real sticklers about reducing principal, which would help a lot of homeowners and would prevent a lot of homeowners from walking away. They've also been able to work with those federal agencies and saying, hey, if a hurricane blows through, like, for instance, in Texas and Florida and Puerto Rico, federal agencies have had protocols to respond to those, declaring them natural emergencies and the like, and so that they're not engaging in the same sorts of foreclosure practices when a disaster hits. And I think New Jersey has found a combination of carrot and stick ways to bring the federal agencies to the table so that they are amenable to playing along. But I think I think the thing is, because we're dealing with emergencies, because the alternative for the lender is to foreclose on a property that isn't worth anywhere near what they lent on it, and to go through, the homeowners are really serving as like general contractors themselves, trying to arrange for the funding and the financing and arrangements of all the repairs. The lenders don't have to do that under these provisions. And in return, especially under a forbearance, I mean, gosh, you're not even requiring the lender to give up any loan principal. They're just saying you don't get it nearly as quick as you would. So for that, for those reasons, it's on legally solid grounds. They haven't faced any legal challenges that I know of. And that was as of, I was last talking to these folks in New Jersey in the fall.
And they actually implemented this when, June 17th, 2019?
I think that was the extension. I think it's been in place for,
right.
Yeah, so it's been in place for a few years. Sandy hit in 2012. I'm not sure if this went into place in 2013 or 14, but the premise was people are unable to live in the homes. They have to pay for other housing. Can we defer their mortgage obligation while they're away?
And that meets the profile of when your home is being, lifted up, the foundation replaced, and then set back, and then you have to get all of the utilities hooked back up. You can't live in that home. So, I mean, it literally follows that same profile. And it's an easy lift, I would think, to make the linkage to a natural disaster based on a natural element in the ground.
Right. And that's the key, is you got to tie, saying that the mortgage as written needs to be modified. It's not something you do lightly, but if you can connect it to an emergency situation, it should pass muster. So if you want to, I'm happy to put my brain more into this. I wanted to float this out to you and at least get the discussion going. And if you want to pick it up, I'm happy to get up to speed and help figure out how to adapt what New Jersey's done and the lessons they've learned to make it work for us.
I have to tell you, this is one of the greatest things I've seen pertaining to the entire issue, because we've always been of the opinion that you have to do it prospectively. You can't do it going back. This actually creates basically a format to go back and be able to grant these folks that they want to do the right thing. They don't want to walk away. They want to pay their mortgage. They want to get their home repaired. They want to pay their taxes.
Yeah.
But it gets them to a place where they can actually accomplish that.
And I think because of the area where this was most likely, if you're drawing Stafford and then, emanating outwards, you're affecting the types of mortgages that were of a low enough dollar amount to be federally backed, and where subprime lending was less rampant and sort of non-traditional lending was less rampant. So you have so many people with federally backed loans who are running into these issues where, you have a Fannie Mae who doesn't want to create a new precedent by saying, oh, you can take $100,000 off your mortgage because you're facing a $200,000 bill. Because if I say that to you, then I have to go do that everywhere else. So it's been, and I'm sure you know it, and your constituents know it better than me too, about banging your head against the wall with those agencies. So I don't know. I'm happy to help in any way I can make this happen.
I'd love to have you as part of that conversation with the approval of the chairs, because this really is groundbreaking. Pardon the pun.
Great. I'm glad it was helpful.
Thank you for submitting this testimony and bringing this to us and actually showing that we may have a way to make this happen, and not just going forward, but retroactively.
I'm sorry, I was too slow. It took me like 6 or 7 months to think about its applicability to foundations. I was only thinking about it in the pandemic sense.
Oh, again,
but, good.
I can't thank you enough for testimony.
Thanks, Representative Delnicky.
Again, thanks, Madam Chair.
Representative Doucette.
Thanks, Madam Chair. Thanks, Jeff. And I share Rep. Delnicky's enthusiasm for your testimony and for bringing that New Jersey legislation to our attention. I guess I wonder whether or not the fact that I'm assuming they got a FEMA declaration for Superstorm Sandy. We have explored, I know, but have not been able to get any type of FEMA declaration here in Connecticut relating to crumbling foundations. I wonder if that has something to do with it, if there was any federal action that was taken, either formally or informally, that coincided with that New Jersey legislation that helped them and allowed them to have a smoother path and less opposition or from any in the lending community. So I'm not sure if you know any of that, but it would be, I think bear some further research on our part as well to maybe look into that.
Yeah.
Because it seems like perhaps this may have been a scenario where behind the scenes, like I said, either formally or informally, the federal government was able to participate in, thus the secondary market and the GSEs were also able to have any of their concerns or issues allayed, and sort of went along with this, and everybody's working on the same page, which is perhaps more of a challenge for us here. I did want to ask a question as to if you have any opinion on whether we've had some discussions about the EMAP program, for instance, that CHFA administers, and perhaps expanding that program or changing that program. Do you think that program would be able to adequately assist a homeowner in a crumbling foundation situation? So somebody who either the scenario that they're awaiting their assistance from CVSIC, they have to move out of the house, they need a short-term forbearance, or B, as Attorney Porras alluded to earlier, sort of a longer-term financial distress situation that's been created as a result of the foundation. With the EMAP program, either in its current form or, if we were to enlarge it in terms of the criteria and so forth, be able to help those homeowners, you think?
I think you'd want to do because depending on, well, I guess you'd be looking to assist with the mortgage payment and not necessarily finance repairs through EMAP. If you're looking at it that way, EMAP could be helpful. One problem, and though you'd almost want to put some specific language in to say, to account for the crumbling foundation piece, because EMAP does consider house value in their underwriting. And so if somebody is steeply underwater, which they may be if they're facing a large bill that there's not a way to pay for, EMAP's not been, is not a great vehicle in that situation. And like I said, you don't want EMAP for financing the repairs without some significant amendments to EMAP, because if you get more than 50,000, CHFA's got some extra additional hurdles to get a loan of more than 50,000 or 70,000 or 100. But that being said, somebody who's facing, who can't pay their mortgage because they're facing additional housing costs and they can't get a workout from their lender, that's where EMAP sweeps in.
Right, exactly. So yeah, it seems like it might apply better in that sort of longer term financial distress situation where you have somebody who's affected by the problem, has already missed some payments. It could be a prospective, they're expecting to miss payments, or they, it's a extreme burden for them to make those payments. At the same time, they have to move out of their house and all that kind of stuff. So no, it's just a thought that occurred to me as well, and we're going to be looking at that with some other legislation coming up here soon. So it may be helpful in that context as well to think about this issue. So thanks again.
Sure. For what it's worth, I think about EMAP as really the state stepping in as a last resort lender when the current lender refuses to do anything or can't do anything for whatever reason. So there's a greater expense with that, relative to saying, to the lender, you have to follow these steps, but EMAP's certainly an option. And if there's issues that CHFA sees in extending EMAP to some of the situations that your constituents and Representative Delnicky's constituents and others have seen, then we should have that talk with them.
Agreed. Thank you.
Thank you, Representative Doucette. Representative Gucker.
Good afternoon, Jeff. It's always great to see you, and it's always great to hear your great ideas and plans. If anything, I can't think of a better closer for the day, because I believe we started off this meeting with how important it is to hear from the public to help us guide, but also give us the information we need to make great legislation. And I also want to say this is why it's important to partnership with organizations such as yourself. And it was very refreshing. And I saw the glow and smile in Representative Delnicky's face when he saw an opportunity that we can help with the crumbling foundations situation. But it does speak well to your organization as far as being involved in the community, as far as also thinking outside the box, and maybe bringing forward some great ideas that'll help us with this legislation. So going forward, I appreciate all that you've done. You've exemplified exactly why we need to have public hearings and we need to reach out to talk to various communities. And I as well look forward to working with you further on helping us navigate some of this, because it's always good, to have somebody who's in the know and in the business doing somebody who works on cars for a living. It's always people come to me for advice with cars. When it comes to banking, I reach out to you. So that being said, thank you again for your time. And thank you, Madam Chair, for this opportunity to brag a little bit about the work that Jeff does. Thank you.
Thanks.
Thank you, Representative Gucker. Thank you, Jeff, for your testimony and the work that you do. And seeing no other hands raised, we will conclude this public hearing. And do I have a motion? Do I have to have a motion to adjourn, or can we just adjourn?
I think we can just adjourn.
Okay, good. Then we are now adjourned. Thanks so much, everybody, for your participation, especially people who joined us to testify and share their experience and knowledge with us. Truly, truly appreciated. Take care, everybody.
Thank you, Madam Chair. Take care.
Thank you, Madam Chair.